There is a risk premium for U.S. assets that was not there before.
Investors should be overweighting or certainly exposed to non-U.S. markets.
We're having our usual bulls versus bears debate.
This notion of U.S. exceptionalism being over is a narrative. I don't buy it.
There's nothing that beats our capital markets. They continue to be the envy of a world.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Wednesday, Elon Musk is pushing back.
I was disappointed to see the massive spending bill, frankly, which increases the budget deficit, not just decrease it, and undermines the work that the Deutsche team is doing.
The tech titan disappointed by the tax bill making its way through Congress. As a weak 40-year debt sale in Japan keeps the pressure on the bond market, equity investors turning their attention to Nvidia, wrapping up Mag 7 earnings after the closing bell.
If you wanted any example of how this year is really just an exercise in wildly turning to nowhere, it is Nvidia, which is up 44% from the lows in April, but up just 1% year to date. And what we have seen is a company where there is a real question of how much the narrative has shifted. Yes, China can't provide that incremental supply, that incremental demand, but at the same time, can they replace that maybe with the Middle East, with other customers?
Demand hasn't been a problem at Nvidia for years. It's always been about supply, whether they can meet that demand and whether they can get around the restrictions down in Washington, D.C.
It's about supply and it's about the walls going up. And we saw that in April with the Trump administration basically saying these chips that Nvidia made to make sure they can go to that critical market of China and export there from the Biden era. The Trump administration says, no, that's not enough. We actually don't want you sending any of this to China. And to Lisa's point, Jensen Huang was giddy in the Middle East when I was traveling with the president. He was at every single stop. And the question is there enough insatiable demand in the Middle East to fill the lack they have of that demand right now because of the walls going up in China?
We'll be catching up with Jensen Huang 6:30 p.m. Eastern Time. A little bit later on this evening, Ed Ludlow sitting down with the man himself after we get those earnings, so look out for that. Also focused on the bond market this morning. Yields are higher at the long end of the curve. Hello, Japan. Hello, a 40-year debt sale that didn't go too well.
Yeah, they had the weakest demand ratio since July 2024. Why? This is really the ultimate question, given the fact that the Bank of Japan owns most of the bond market. And you talked about yesterday how the Ministry of Finance came out and said, look, we're going to issue fewer long-term bonds. So then what was the problem? And that actually is giving more jitters to people who are saying, really, is this actually a risk-free asset, even if you have the backstop of fiscal authorities potentially reducing long-term issuance?
This is the supply out of Japan. Later on today, the supply out of the U.S. in focus will get $70 billion of 5-year notes today. Tomorrow, $44 billion of 7-year notes. A heavy supply slate coming from Washington, D.C.
At a time when there's a real question about exactly what Elon Musk had to say, how much does the current budget plan increase the deficit, and how much are really talking about deficit concerns versus an economy that's still facing off with the potential for inflation? To me, this is, I think, the crux of the issue. What is driving the bond market? How much is actually fiscal? How much is actually inflation? And how much is it that people are just looking to alternatives because the volatility has been a little stomach-churning and they kind of don't want to deal with it?
Elon Musk says the bill can be big or it can be beautiful, but he says you really don't know. Can it be both? It's his opinion. The problem is, of course, is that what this administration is doing is when Trump came in January, this term came from the fact that a number of individuals wanted spending on immigration. Others wanted the tax cut. And Trump said, put it all together. And that is why you have a massive bill that I guess Elon Musk is now starting to read the CBO and the Penn-Wharton model. It's going to add trillions of dollars to the deficit.
He's pushing back. How many fiscal hawks in the Senate agree with him? Bond yields are a little bit higher this morning. Equity futures are a little bit lower. Coming up this hour, we'll catch up with Christian Nolting of Deutsche Bank as the rally loses steam. Ed Mills of Raymond James on the Nippon Steel tie-up. And Frank Lee of HSBC looking ahead to earnings from Nvidia. We begin this hour with stock steady ahead of more economic data and Nvidia results. Joining us now, Christian Nolting, the Global Chief Investment Officer of Deutsche Bank Private Bank. Christian, welcome to the program, sir. There has been a near obsession for a number of months now about the spread between the hard data and the soft data. The soft data has been terrible. The hard data has been resilient. A lot of people believe the hard data would catch down to the soft data. After consumer confidence yesterday, could you get your head around the idea that maybe the soft data could maybe bounce back up to where the hard data is?
Yeah, that's a very important question we're also discussing, right? Are markets too optimistic for what's going on? Actually, first, for the hard data, we do see growth coming down a little bit. So forecast for the US for this year would be 1.2, but then moving higher a little bit into next year. So that's hard data. I think that's not a recession. That's good news in a way. The soft data, of course, I would say let's not be too optimistic here. There could be some downside there, I would say. From that perspective, I think it's probably a bumpy road ahead. But if you look for 12 months, we do still see another 5-6% on gains, for example, on the S&P 500. But it will come with some volatility.
Yeah, it's been stomach churning, Christian. I feel like what we're going to get from NVIDIA just highlights just how stomach churning it is, given the fact that after their earnings reports, they tend to move about by some $200 billion of market value. I'm just wondering if we have any conclusion after almost 6 months of this year, this sense of where we are, what has changed in terms of both risk appetite and where the haven trades are.
Yeah, I would say what has changed a little bit is the volatility, clearly, right? We had long periods last years, I would say, where volatility was extremely low. But I think this year, and let's say also especially for the next 6 months, we will see more of that volatility. I think that's a change. That's also factored to some uncertainty. What will be eventually the results of the trade tariff negotiations, very important from my point of view. But then the good news in a way was on the earnings so far. So earnings expectations have come down, but the earnings season, we will see tonight, of course. But so far was a very decent one. From that perspective, that helped markets. Now, in the second half of the year, we do think inflation will probably go higher even in the US. So that's number one, which could cause volatility. Then, of course, earnings have still to be delivered, but expectations are a bit lower. That could be a positive. And especially we think that for tech, digital earnings, for financials, that could be very positive. So that's good news from that perspective. But on the other hand, and as you rightly said before, we also need to look at inflation being higher, and that has a clear consequence on the yield side as well. So if we see yields then going substantially higher from where we are right now, I think that could also weigh on equity markets.
Christian, what's driving the bond market right now? Is it the expectation for inflation? Is it fiscal overhang? Is it just jitters over recent volatility?
Honestly, I think it's all three of that. So first of all, it's supply demand. We have seen this with Japan. We've seen that also in the US. We are having some discussions here in Europe as well. So supply demand on that side, especially on the longer end. Then secondly, I think there is in this market a lot of discussion about fiscal. Look, US, is Europe then able to spend fiscally in the right way to create productivity? Certainly, we do expect another, let's say, fiscal stimulus program coming out of China. So I think the second half of the year will be a lot of discussion on fiscal. And of course, it's overdone in a way that drives yields CP higher. So that's the second aspect. And as I said, if we see inflation going higher in the US, from my point of view, that would also drive yields more in the longer end, of course.
Christian, how are you navigating this positive correlation between stocks and bonds? The fact that the two asset classes are moving in lockstep. Equities up, yields down. This morning, equities down, yields up. What are you doing with that?
So it's not so bad for a multi-asset portfolio. You have some diversification there. So that's something actually you like. And there were periods in past years where that was not the case. So from that perspective, diversification is key. That's not new. But I think as long as this big one works, I think that's a positive thing. However, it could well be, right, if we see yields to go substantially higher, i.e. losses on the price side, then you could see both assets in the equity space and in the bond space to go down. So that's why you don't have this negative correlation anymore. So from that perspective, what we do is we try to have a global diversified portfolio, and also in the bond space, not only look at government bonds, look at also investment grade, where we think there is a lot of opportunities, by the way, especially in Europe, also from the currency perspective.
Christian, you mentioned tariff negotiations, and a lot of this is driving what we're seeing in financial markets. You said you're keenly focused on them. So which ones are you most focused on?
Look, being based in Frankfurt, of course, there's a lot of focus on the European negotiations. And I think last Friday we got, let's call it kind of a wake-up call with the 50% threatening. So that's, of course, now postponed to July 9th. But so it's Europe. And the second one is, let's not forget about this, is China. So that's the two main focuses we have at this point in time.
Do you think trade tensions, the peak uncertainty of all of it, has disappeared?
I think the ultimate peak, yes. I think we got this after April 2nd. Still then, I think it has come down a bit, especially then on April 9th when Trump said there's a 90-day period. And if I'm not wrong, for China, they've also said if the negotiations go well, we can imagine this could be prolonged another whatever days. So I think we have seen the peak, but that doesn't mean we are very low now. It's still very high, the uncertainty, but I think the peak we have seen in the week from April 2nd to April 9th.
Hey, Christian, appreciate your time. As always, Christian Nolting there of Deutsche Bank Private Bank. Sharp rebound in US consumer confidence in yesterday's session. Biggest monthly gain in some 4 years. And about half the responses in that survey came after the May 12th US-China trade truce. So that tells you a lot about how much more this could still be in the pipeline. There was this feeling that people felt very concerned about both the inflation and the forward drag on growth in the wake of what happened on April 2nd. The ability for people to completely shift back their opinions, not only about the current conditions, but future conditions in a way that we haven't seen since the direct aftermath of the Great Recession in 2008 and 2009, gives you a sense of just how much can change in the soft data, not just the hard data. Fantastic snapback in consumer confidence, and we hope to see more of that in the months to come. Equity futures on the S&P negative by just 0.1%. Let's give you an update on stories elsewhere this morning with your Bloomberg brief. Here's Yahara Anand. Hey, Yahara.
Hi, John. As you showed at the top of the show, Elon Musk is pushing back on President Trump's tax bill. The billionaire who said he was stepping back from Doge last month says the bill undercuts what Doge was all about, slashing government spending. Speaking to CBS News, Musk said, "I think a bill can be big or it can be beautiful, but I don't know if it can be both." Meanwhile, his company SpaceX suffered a third straight setback for its Starship program last night. During a test flight, the massive rocket booster exploded before the Starship itself suffered a leak. It then tumbled out of control and disintegrated as it came back to Earth. It also failed to deploy dummy satellites as planned. And Stellantis has appointed a new CEO. It's America's head, Antonio Filosa, will now take the reins of the company. The automaker is hoping an experienced insider will turn around the automaker after former boss Carlos Tavares was forced out over weak sales and profit. That's your Bloomberg brief. John?
Yahara, thank you. They've got a lot of brands to figure out what to do with, that's for sure. Yahara's going to join us a little bit later, again this hour. Up next on the program, making a deal with Nippon Steel.
I will stop Japan from buying United States steel. I would not let U.S. steel be sold to Japanese.
It'll be controlled by the United States. Otherwise, I wouldn't make the deal.
It's a big change for the President of the United States. We'll get into the why in just a moment. Ed Mills of Raymond James joins us next, live from New York City this morning. Good morning. Live from New York City, welcome to the program. Equity futures just a touch softer here, negative by only 0.1%, basically unchanged on the Nasdaq 100. Under surveillance this morning, making a deal with Nippon Steel.
I will stop Japan from buying United States steel. They shouldn't be allowed to buy it. U.S. steel is being sold to Japan. I don't like that. I would stop it if it hasn't been completed by the time I'm president.
It'll be controlled by the United States. Otherwise, I wouldn't make the deal. I'm doing it because everybody seems to want it.
Here's the latest this morning. President Trump surprising markets, supporting the sale of U.S. steel to Japan's Nippon Steel. Sources telling us here at Bloomberg the U.S. government is poised to receive a so-called golden share as part of the tie-up. Joining us now from the nation's capital, Bloomberg's Tyler Kendall. Tyler, this is a big U-turn from a campaign promise. What's behind it?
Yeah, hey, John. So there's a few different things that could be here at play. We know that President Trump made this announcement after a phone call with Japan's prime minister last week. And also, this White House really has been seeking new investment commitments. And it appears that Nippon was able to sweeten the deal by offering up to $14 billion in new investment, up significantly from their originally proposed offer. Now, there are still a lot of big details here that are still missing on exactly how this is going to play out. As you heard, President Trump had vowed that U.S. Steel would never be foreign-owned, and instead it is now being billed as some sort of partnership. But really at the heart of the questions is that any sort of deal is going to have to abide by some sort of national security agreement in order to reflect conditional approvals by the Committee on Foreign Investment in the U.S., or CFIUS. And you mentioned one of them there. People familiar telling Bloomberg News that the U.S. is poised to receive a so-called golden share as one such condition. This would essentially allow the U.S. government veto rights on certain company decisions, things like offshoring or shifting supply chains. But, John, at this moment, it's unclear the full scope of that and whether or not that would amount to some sort of equity stake or really simply just mitigation powers.
Well, Tyler, in January, the Biden administration blocked the sale. So procedurally, Trump needs to actually unblock it. And then he said on Friday he's going to Pittsburgh. So how is he going to sell this to Pennsylvania?
Right. I mean, this really was a flashpoint on the 2024 campaign trail. The Steelworkers Union was really against Nippon's bid, instead in favor of Cleveland Cliffs, instead making some sort of acquisition here. And actually, you'll recall the one place of overlap between the two candidates the day before Election Day was that they both went to Pittsburgh and ultimately vowed to block this deal. We have heard President Trump start to bring in his ideas of how tariffs have helped the steel industry. He said it in his post announcing this so-called partnership. And we should say, by and large, the steel industry has actually been happy with the more protectionist policies when it does come to steel. But it is going to have to be sort of threading the needle here for this White House, since we know that the Steel Workers Union really was against this on the basis of national security concerns and concerns about what this will mean for jobs. Annmarie, we had Stephen Myron of the White House on Bloomberg Television yesterday, and he said that the White House is confident that Nippon will make good on its investment and job security commitments.
Tyler Kendall with the latest in Washington. Tyler, thank you. To extend the conversation, Ed Mills of Raymond James joins us now. Ed, welcome back to the programme. Let's just start with this deal. What do you think is behind the change of mind for the President of the United States?
They say the only constant in life is change, and man alive, does that apply to Donald Trump? So I think the reason why he was opposed to this deal in the beginning was that it was a political headache for Joe Biden. It was a political headache for the Democrats who are running for re-election in the Senate in Ohio, in Pennsylvania. Both of those Democrats lost. Now we are talking about a golden share. Where have we heard a golden share before? That was what we found out was going to hold up any sale of TikTok whatsoever. So Donald Trump criticized that structure and now is embracing that structure. This is a political move because, as mentioned, there are a lot of folks within Pennsylvania who are employed by U.S. Steel who want a deal to get done. There was a kind of infusion here by Nippon that a lot of folks look at as very positive. And so now that a lot of the locals who could have suffered some job losses have been on board, it gives Donald Trump the political cover to get this done. And at the end of the day, what does Donald Trump always want? He wants investment in the United States. And if he can get investment and he can tie that to the trade deal, he's going to move forward.
What is basically in this golden share? What does the U.S. get?
Nobody knows. And so we have to wait to find that out. And when I talked to investors about this deal yesterday, one of the big questions is, what will be the final price of this deal? And once you do issue a golden share, do you need a new proxy? Do you need a new shareholder vote? This elongates the timeline. We've gotten information via tweet, but the actual information here has not really been fully fleshed out. And so once we know what that is, we can answer some of those other questions. But it is a big question for the merger arb community in terms of, is this new policy? What exactly does this mean? What is the timing behind this? We maybe, if we have an equity stake, does this go into the sovereign wealth conversation, the fund that he's trying to create? Is this part of a larger conversation about the debt and the deficit? Nobody knows yet. A lot of details, Annmarie, to be filled in.
Well, golden share sounds like a great branding opportunity for the Trump administration. Based off what I've read and some of the reporting out there, basically what they want to do is make sure that they have U.S. government approval of the number of board members, U.S. members on the board. Also, in a CFIUS-like agreement, basically could mean that they have rights over actions like offshoring and shutting down production lines. If that is the case, Ed, is that politically enough for Trump to go ahead with this deal?
I think so. I mean, those are all going to be things that you could have put in a mitigation agreement. When I was on Capitol Hill, I worked a lot on the creation through legislation of the CFIUS process. And when we looked at this deal last year, there was no one with a straight face that said you couldn't use that process to come up with a mitigation agreement. But politically, if you say, hey, we will not allow U.S. Steel and kind of owned by Nippon to cut production, we say it's okay. We will not let U.S. Steel export any steel unless we say it's okay. Politically, that deals with the national security issues that the Trump administration has been trying to deal with the different Section 232 tariffs. So anything that allows him to not have to explain away some of the national security concerns he's already brought up is political cover that can get this across the finish line.
Well, the deal was blocked in January by then President Biden because of national security concerns. How does Trump actually procedurally overturn all of that?
Well, I think that anyone who looked at those national security concerns did not think that they were things that could not be mitigated against. The CFIUS process allows for those mitigations. It was a political decision as much as a national security decision. I would say even more of a political decision than national security. So once you're able to get those mitigation procedures in place, it was always something that could get approved. It was just one of those things that it was at an uncomfortable time politically, and the Biden administration didn't want to have this approved and then lose Pennsylvania. But the problem for the Biden administration is that they blocked it, and they still lost, and they lost those Senate seats as well for Democrats. So it's just a real question as to why were they willing to kind of let that drag out as long as it did, letting this kind of come into fruition once Trump took office. I think it's one of those things, if you have a political problem out there, solve it as quickly as possible and move on, rather than let it linger and let those political ramifications take you under.
You started, Ed, by saying that the only thing that's constant is change, particularly when it comes to President Trump. It's helpful for people to understand what's driving that change. Is it political realities, whether it's in polls? Is it market responses to certain proposals? Is there a sense of what's causing President Trump to ratchet back some of his threats with both tariffs as well as potentially with blocking certain deals?
Yeah, Lisa, when I talk to folks that have been in and around him for trade, they say the driving force for him is getting companies to invest in the United States, in countries to come up with a agreement in terms of how much they will purchase from the United States, how much new market access they can get from the United States. And so I have always viewed this trade fight as a desire, one, to protect national security, two, get new revenue for the tax bill, and number three, see if you can use the force of the economy of the United States to get that change. And so when I look at some of these deals, it is a bit of a political reality, but it reflects what he likes to do. He wants to be able to say, at the end of the 90-day pause, I was able to sign trade deals, even though there'll be MOUs, not trade deals, with 100+ countries representing Y trillions of dollars of new purchases and X trillions of dollars of new market access. The dollar amount matters to President Trump. And if he can ring up the cash register, he views that as a political victory. That's his driving force.
Ed, do you think we're blurring the lines, though, between accelerating American capitalism and central planning?
Yeah. That is absolutely going to be the truth, but it is going to be something that I want to have investors take a step back and say, all right, to the extent that you can get some of these deals, that's going to be positive. To the extent that we can count investments that were already going to be made towards that, can we move on with our lives is kind of really the question that I get from clients. As long as we know that Trump is transactional, I think a lot of investors feel that it is not ideologically driven. I think where we get the most concerns from investors here at Raymond James is when they think there's an ideology behind this that is not solvable. As long as there's some sort of capitalism behind that, people can adjust to that and get some level of comfort in this market that the trajectory here is positive.
Constructive framing, Ed. We appreciate it. Ed Mills there of Raymond James on a situation down in Washington. The president wants to make a deal.
Yeah, well, as long as there's some sort of capitalism behind it, people feel comfortable, evidently. Those were, it's a memorable phrase.
Happy to see that. Coming up next on the program, Frank Lee of HSBC looking ahead to earnings from NVIDIA, live from New York. You're watching Bloomberg TV. 2% rally on the S&P 500 just yesterday following a 4-day slide this morning. Slightly softer by not even 0.1% on the S&P and just about unchanged on the Nasdaq. With 3 hours until the cash open, let's get you some morning movers. Let's cross over to Danny Berger. Hey, Danny.
Hey, John. Not a lot of drama underneath the surface either. We do have Nvidia gaining 0.6% ahead of its earnings after the bell today. Now, it did have a really strong day yesterday, so taking a little bit of a breather from that big rally. Morgan Stanley calling this quarter a messy one after that announced $5.5 billion write-down of its inventory of chips that were originally designated for China but now face those new restrictions. A lot of questions for Nvidia, again, after the bell today. We also had a really strong day for Stellantis yesterday, up about 6%, which might be why we're down nearly 0.5% in the pre-market, but probably not what you want to see if you're Antonio Filosa. That is the newly appointed CEO of Stellantis. You'll recall the one before Tavares was pushed out. So many problems with this company, from demand to supply chains to EV stress. A long road ahead for that CEO. Again, those shares slightly weaker in the pre-market this morning. Finally, Booz Allen decisively falling down more than 2.7% this morning. Goldman Sachs publishing a note downgrading the company to a sell, saying that the government contractor sees limited potential for upside for things like revenue, given the fact we have had a pullback on spending from federal governments. Now, to be fair, the market already sees this. It's down 15% this year. And Booz Allen last week announcing it would cut about 7% of its workforce. John.
That outcome is very much by design in Washington, D.C. Danny, thank you. That stock is negative by 2.8% in the pre-market. On our radar this morning, Nvidia, the stock to watch. The company reporting earnings after the closing bell. Investors waiting to see how export restrictions to China impact the chip makers' bottom line.
Yeah, how do they give any visibility at a time where policies have been changing? They did have a chip that was designed specifically for China. That was a designation that was essentially revoked by the Trump administration. You raised an interesting point. It's not just the question of demand, it's also supply, and whether they are seeing supply chain disruptions or any kind of fissures just because of some of the trade negotiations that we've seen going on.
Morgan Stanley said there's simply no offset to this, and already we've seen the company have to take more than $5 billion write-down for these chips, which is really astonishing. They designed to get around other export controls. They were supposed to be compliant. The Trump administration in April said you're going to need a license indefinitely to send these H-20 chips to China, basically, which means none of them are going there right now. And if there's no offset coming from the Middle East, where else will there be an offset? This is a real challenge for them.
We'll get the view from HSBC in just a moment. As Lisa pointed out a little bit earlier in the programme, a 44% rally off the April low on this stock. I want to turn to this story. The US government set to receive a so-called golden share in the US Steel Nippon Steel deal. Sources telling us here at Bloomberg the agreement gives the government de facto veto rights on certain decisions and appointments.
So basically, it is a golden branding opportunity for the Trump administration to try to get this through with some, as Ed Mills called it, political cover. So this golden share, we still have a ton of questions more than answers, but basically what this would allow it to do is more U.S. board members could be on part of the company. They would allow veto to things like production cuts. If there is national security concerns about supply chains, the U.S. government would have potentially this veto. Actions like offshoring, shutting down production line, all of this potentially the U.S. government would have a say. Is that going to be enough political cover, though, for a man that ran basically on saying this deal will never get through if I'm the Oval Office?
It looks like that deal is going to get through. That's for sure. I want to finish on this. Elon Musk having his say, pushing back on President Trump's tax bill. The tech titan saying it undermines the Doge team's efforts to cut government spending while increasing the budget deficit.
Is this an apology tour or maybe just a distancing tour at a time when Elon Musk is trying to turn the focus back to his companies? I find the fact that he's saying this now interesting, given some of the issues that he's having with some of his portfolio companies that he wants to focus on. How much is he actually going to hold clout with the president and, frankly, senators who might agree with him? And how much is this a personal branding opportunity to say, look, I had an effort. It wasn't part and parcel with the whole administration. Don't blame me for everything there. Buy a Tesla.
The timing is also off on this. If anything, you would need Elon Musk running Doge right now to offset those concerns a lot of people have when it comes to the one big beautiful bill, which basically was started only in January because, remember, there was this huge debate between the upper chamber and the lower chamber if we just do a separate tax cut policy along with an immigration package. And Trump said, enough of this, just put it in one big beautiful bill. Elon Musk, though, is seeing how much actually Washington likes to spend, whether it's Republicans or Democrats, just like to spend on different things.
What did he say? It could be big or beautiful. It can't be both.
Yes, because basically Elon Musk is saying for it to be beautiful, it needs to be smaller, it needs to cut the deficit.
That's the latest in the nation's capital. Let's turn back to tech. Investors bracing for NVIDIA results after the closing bell as China export curbs weigh on the chip maker. Joining us now to look ahead, Mandeep Singh of Bloomberg Intelligence. Mandeep, welcome to the program, sir. What are you focused on later this afternoon?
Well, we know that China is the focus, but for me, gross margin is where we can determine, NVIDIA's pricing power. And right now, everyone is fixated on power supply. 6 months back, everyone was fixated on supply of GPUs. I feel that concern has alleviated, and the focus is more on power. And so what I want to know is how does that affect NVIDIA's gross margin in terms of supply concerns abating? And look, the geopolitical tensions are still there. They may have to move some of their supply chains, but in the end, it comes down to gross margin because that's the biggest determinant of NVIDIA's free cash flow.
There's also a question, Mandeep, about the hyperscalers that have come under some unique pressures. I'm thinking of Google or Alphabet, the parent company of Google. How much do you expect some of these companies to increasingly become competitors, not just customers, and for that to be part of the narrative mix stemming from earnings today?
Absolutely. I mean, look, we know NVIDIA's revenue is concentrated with the 5 big hyperscalers. And we also know OpenAI is trying to branch out on its own when it comes to building its data centers, et cetera. So from that perspective, the commodification of LLMs. So if Gemini is catching up to OpenAI, that's bad news for NVIDIA. And look, for NVIDIA, clearly they want the LLMs to standardize on their chips, but there are a lot of alternatives emerging, especially in China. And if, Chinese aren't getting the supply of GPUs and they're still able to train the models, they are setting up a precedent that you can do inferencing without NVIDIA GPUs. And that is what will determine in this AI infrastructure supercycle what sort of market share will NVIDIA have 2 years from now or 5 years from now.
The stock is positive in the pre-market by 0.6%. Mandeep, appreciate your time. Mandeep Singh there of Bloomberg Intelligence to build on the conversation. Joining us now, Frank Lee of HSBC, who has a hold rating on the stock and a $120 price target on NVIDIA. Frank, welcome to the program. I just want to build on some of the conversation we've already had so far this morning and understand from your perspective why this won't be the beat and raise quarter that maybe some people got used to in years gone by.
Yeah, I think if you look at the beat and raise, we haven't really seen that for the last couple of quarters of NVIDIA since the second half last year. So I think what you're seeing is that, and one of the reasons I think we see is that there's still some ongoing challenges they're facing this year, which they didn't face last year. Number one, you had, the supply chain is still having some ongoing issues, especially on the downstream side and the way they ramp their NVIDIA rack architecture. We've had the China ban come through earlier as well. And also, I think the GTC roadmap that was launched, it wasn't as exciting as people had hoped. We're not seeing a huge spec migration that will drive this incredible pricing power going forward. So these, I think, were the headwinds that I think NVIDIA is facing in the first half of the year. And I think as you go into earnings, I don't think there will be a major surprise. I think the market has gotten used to that already. Expectations for the revenue has come down over the last 3 months. So I don't think there will be a big disappointment either. So I think the focus, though, will be probably as we go into 2026.
There's a question, Frank, about the supply side of this story with respect to supply chains and other issues just creating enough chips to really meet demand. And then there's a question around the demand and how much is coming from China versus the Middle East versus hyperscalers. Which side of the equation do you think is going to be the more important one this earnings season?
I think the focus will be, the narrative somewhat has actually changed quite a bit, especially after I think the Middle East AI deal, because that represents a new greenfield market opportunity for NVIDIA that over the long run could perhaps double their revenue from where we are today. So I think that has been probably the biggest change, and the big reason why the stock has rebounded off the recent lows. However, I think, to get confirmation that this demand from the Middle East will materialize, we're going to have to see between now and end of the year whether the supply chain expectations for next year does continue to reverse. Because since the beginning of the year, what we've seen is that the capacity on the chip side allocation has been coming down. So as this trend starts to reverse as we get into next year, that will be seen as a very important indicator. We may not see that for another couple of months, but that will be something I think is really critical, because that establishes your baseline for 2026 that it can grow again. Because I think prior to this narrative, it was just really the hyperscaler capex will slow, and they will also see more of a focus on their own chip, the ASIC chip, and that's why we see Broadcom seeing a very strong growth for next year as well.
Frank, it was a pretty remarkable moment in a photo op when you have Jensen Huang basically standing in between President Trump and Sheikh Mohammed bin Zayed in Abu Dhabi when they signed this AI partnership. But whether you put all of these deals together across the Gulf, is it enough of an offset for what's happening with China?
I think right now the narrative clearly is there to suggest that it is. I mean, they've talked about 600 gigawatts that potentially over the next 10 years or so could double their revenue to 200 billion. But that's the narrative. Whether it materializes or not, we'll have to see. I think, again, as we see next year, that the supply chains start to see upward revisions. We've been in a downward revision since the beginning of the year. Now, does that start reversing course? I think that will be an important thing to see, because that's going to be the most, I think, a very important driver for NVIDIA next year. The hyperscaler will slow down. I think they know that, and I think they've been preparing for that, which is why I think at Computex, Jensen also talked about, willing to sell the networking chip, so he doesn't have to buy, the hyperscalers don't have to buy the complete solution from him. So I think he's become more open-minded about selling, other chips besides the entire solution.
Frank, just to wrap it up, we'd love a thought from you on the man himself, the leadership, Jensen. Tim Cook, increasingly out in the cold at the moment with regards to the relationship with the President of the United States. What is Jensen doing right?
Yeah, I think it's an interesting one, because Jensen clearly has expressed desire to continue to sell into China. He's been very vocal about it. In fact, I think, they are working on another chip that they plan to sell into China that can I guess, get around some of the restrictions we're seeing today. But on the other hand, I think he's also quite supportive of the loosening of AI diffusion. The deal in Saudi Arabia, I think, was a good start. So I think he's also been very supportive and appreciative of the administration about going in that direction.
Frank, given his pursuit of China, though, and China is a major customer, do you see tension down the road between the two individuals?
I think, what NVIDIA has proven to be is very adaptable. So they've been, every time there's been a restriction, NVIDIA has abided and followed it. They just come up with another chip that basically falls below the criteria benchmark. And so I think he will continue to do that. But again, in a fashion that I think is pretty much well telegraphed. So I don't see it as being a negative source of tension. I think, he still doesn't want to give up on the China market, but at the same time, I think he's also looking to follow whatever the restrictions are placed, and he'll find ways to meet them. So.
Got it. Hey, Frank, appreciate your time. Frank Lee there of HSBC on NVIDIA. Earnings from them a little bit later this afternoon. Jensen Huang's really navigated this situation well, the tension between the US and China.
It also helps to have something that everybody wants, and that can be the key to a lot of deal negotiation. And I wonder how much some of this is part and parcel with trade negotiations, geopolitical negotiations. It is a convenient person to have by your side for Donald Trump.
Are you saying we don't want iPhones anymore?
I'm saying that there's more competition. I'm not saying that we don't want iPhones, but I think that that's an important question. Is that less of the gold chip that you might be getting from the likes of an NVIDIA chip?
Without a doubt. NVIDIA this morning in the pre-market positive by 0.6%. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Yahira. Hey, Yahira.
Hi, John. President Trump warned Vladimir Putin in a social media post that he's, quote, playing with fire. The U.S. is deciding whether to hit Moscow with additional sanctions after it launched its largest ever drone attack on Ukraine. Trump also wrote that if it weren't for him, lots of really bad things would have already happened to Russia. Meanwhile, Nissan is seeking an urgent turnaround plan as it faces a looming debt crisis. Sources telling us here at Bloomberg, the company plans to raise over $7 billion from debt and asset sales, including selling part of the 15% stake it owns in French carmaker Renault. This all meant to address a huge loan repayment due next year. And round 2 of the French Open is underway. Novak Djokovic, Jannik Sinner, and Carlos Alcaraz all won their first round matches with ease. Meanwhile, top-ranked American Taylor Fritz and Russia's Daniil Medvedev were among the players to suffer upsets. In the women's tournament, defending champion Iga Swiatek and world number 1 Aryna Sabalenka both take the court later today in separate matches. That's your Bloomberg Brief. John?
Very cool. Yahira, thank you. Thank you very much. Up next on the program, King Dollar's reign.
There's literally no alternative to the US dollar and US assets from 6 months ago. The dollar was overvalued, dollar assets were overowned. There's a vulnerability in search of a trigger.
Up next on the program, Eswar Prasad of Cornell University, live from New York City. This is Bloomberg. Equities turning positive in the last 15 minutes or so. Equity futures positive by almost 0.1%, up by 0.2% on the Nasdaq 100, with earnings from Nvidia in focus a little bit later on this afternoon. And a surveillance this morning, King Dollar's reign.
There is literally no alternative to the US dollar and US assets from 6 months ago. There's still no massive, huge liquid alternative, but there are some other kind of currencies and countries kind of popping their head up. The dollar was overvalued, dollar assets were overowned. There's a vulnerability in search of a trigger. It's just going from extremes in valuations, and there is no other place to be to, well, hang on, maybe I can reallocate to some other places.
So here's the latest this morning. President Trump's policy stoking concerns about the dollar's dominance. Eswar Prasad of Cornell University writing the dollar's dethroning is unlikely. Luckily for the United States, and unfortunately for the dollar's detractors, there appears to be no competitor strong enough. Eswar joins us now for more. Eswar, welcome back to the programme, sir. It's always good to get your thoughts on Bloomberg Surveillance. Let's take it from the top. What's the difference between diversification and de-dollarization?
So the two could very well be related, John. What is the reality the world faces is that if you're holding, more than 57% of your assets, that is reserves, in one currency or one asset class, you really should be diversifying, which is something that the world has been trying to do for a long time. So there are very good reasons to step away from the dollar. Now, the issue, of course, is that the dollar is very important, not just as a reserve currency, but as a payment currency, as a funding currency. And in all of those respects, the reality is that there simply isn't another currency that can outmuscle the dollar. Certainly a world in which there were multiple currencies that were competing on an even basis might be a more efficient world. It would create more discipline and more incentives for discipline from the issuers of those currencies. But that's not quite the world we live in right now. And the weaknesses of the other currencies are still keeping the dollar in pretty good shape.
Well, let's talk about some of those weaknesses. It feels like for many that China is just a non-starter because of the lack of capital mobility. What about the Europeans, Eswar? Where do they fit in?
That would be a very logical alternative to the dollar. In fact, when the euro was created in 2000, there was an upsurge of excitement about an alternative to the dollar finally, and the euro did seem ready to fulfill those promises. In the first 7 to 8 years after its creation, the share of the euro in foreign exchange reserves, for instance, went up by about 8 percentage points, from about 20 to 28%. And there was a sense that the euro was an unstoppable linear path to taking over from the dollar. But then it all ended. The global financial crisis and the Eurozone debt crisis revealed that Europe does not quite have all the elements of a monetary union. Yes, there is monetary union, but the true banking union, the fiscal union, and other parts of economic union did not really hold together. So if you think about the core part of the Eurozone, countries like Germany, Austria, the Netherlands, and so on, that's a much smaller share of the overall Eurozone bond market. And even those core countries are not exactly doing very well right now. Germany is struggling, for instance. So it doesn't look like Europe is ready to step up and take on the mantle. And certainly since 2008, the euro has done very poorly. Its share as a payment currency, its share as a reserve currency have all fallen back to about the pre-euro levels.
This is the institutional weakness that you're talking about that leads the dollar to remain on a much longer leash than any currency should rightfully have. That's your words. At the same time, the dollar is still on a leash. And Steve Englander of Standard Chartered said overnight that a U.S. dollar and rates crunch could emerge if the fiscal bill steepens the debt path without boosting growth. How much do you see that as a possibility, say, in 2026 or 2027?
You know, by all logic, Lisa, the dollar should not be where it is. We are seeing that macroeconomic policies in the U.S., especially the fiscal deficit and debt levels, do not show any real discipline by U.S. policymakers. The key elements of the institutional framework that are crucial to underpinning the dollar's dominance, you know, the independence of the central bank, the Fed, the system of checks and balances, the rule of law, all of these have certainly taken a pretty strong beating. But the reality is that if you put the whole package together, the institutions, but also financial market depth and size, and the dynamism of the U.S. economy, even if the U.S. does very poorly in each of these dimensions in a relative sense, it's still doing better than the rest of the world. And that's a difficulty. But having said that, we have certainly seen a fall off in the dollar's share of global asset flows and so on in the last 4 to 5 months. But it's worth keeping in mind that from September of 2024 to about January of 2024, just till about Inauguration Day for the new president, the dollar on a trade-weighted basis rose by about 10%, possibly making it quite overvalued. And then it's fallen back by about 10% to about where it was in September 2024. So if you want to tell a very negative story about the dollar, you start in January. If you want to tell a different story about the dollar, that things have changed, but not really in a fundamental sense, you go back to September 2024 and not that much has changed.
We know the president hates trade deficits. Do you think any of this is strategic to boost U.S. exports?
That's a very interesting question. We've heard very mixed messages from the administration about whether they want a weaker dollar in the short run and a stronger dollar in the long run. Trump certainly has spoken about how he wants the dollar to remain the dominant currency, but at the same time, in many of the issues that we've had with other countries, including countries that the U.S. is running a trade surplus with, the Trump administration has argued that many of those countries are manipulating their currencies to keep them weak, suggesting that the U.S. would prefer that those currencies be stronger and the dollar be weaker. That mixed messaging certainly should be hurting the currency, and it probably is, but it doesn't seem to be a fundamental aspect of policy that they're trying to weaken the dollar through the messaging, but certainly the policies they're putting in place, the increased likelihood of a U.S. recession later this year because of all the tariff troubles, the increasing fiscal deficit levels, all of those are certainly going to weaken the dollar.
I have no doubt this is going to be an ongoing conversation, particularly with you, sir. Eswar Prasad there of Cornell University, doing a wonderful job of breaking this down. DXY. Dollar index, heavily weighted, of course, to the single currency, the euro, but worth tracking. 5-year average 100 this morning. 99 handle. That tells you everything, I think.
There hasn't been that big of a change in a historical perspective. You have seen an incredibly elevated or strong dollar in the past couple of years. And so how much is just a reversal of that? A key question, though, how much is the goal to get a weaker dollar? And Annmarie, you touched on this. In order to boost exports, unclear. They're not willing to confirm that, but a lot of people are speculating that could be part of the case.
Which is why we're seeing these moves in gold. One of the reasons, anyway, of 26% this year, up 27% last year. The rally continues.
There is a search for an alternative. Seem to have coalesced around one that's very shiny and that's very heavy and very hard to put in your suitcase. And yet it doesn't seem like that's actually becoming a replacement, but rather more of a hedge.
Gold this morning up by 0.4%. Up next on the programme, David Lebovitz of JP Morgan Asset Management, Monica Guerra of Morgan Stanley, Congressman French Hill, and Marissa Adams of HSBC. The second hour of Bloomberg Surveillance is just around the corner.
You've hit the peak of tariff uncertainty.
The damage has really been done in terms of supply chains. There is so much volatility.
There's just so much political uncertainty.
The issue is right now we're really waiting and hinging on what the administration does with trade.
I'm not minimizing the impact of tariffs, but it's right now we've been trading like it's all there is to the economy.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Triple header in the last 24 hours or so. Better news from Japan on the debt market, better news from the president on trade, and better news as well on the consumer in America. Consumer confidence bouncing back, leading to a 2% gain on the S&P 500 this morning. We add just a little bit of weight to that. Equity futures up just a touch on the S&P 500, positive by 0.1%. On the Nasdaq, up by a quarter. The Nasdaq 100 in focus later on this afternoon. We'll get earnings from Nvidia. Nvidia in the pre-market, positive by 0.6%.
So there's so many different overlapping stories. On one hand, you have consumers feeling a lot better, at least according to the conference board data yesterday, because there has been a walking back of some of the trade tensions. Do you see that same sort of relief in the Nvidia earnings today about the walking back of trade tensions that have led to a decoupling, no, trade, yes, with China, and just where they go from here as they try to replace demand, not necessarily with China, but from the Middle East?
We spoke to HSBC a little bit earlier on this morning, not expecting the beat and raise later on this afternoon. Their focus, the big question for a lot of people in this market this morning, how are they going to navigate the restrictions and meet that demand in China?
HSBC thinks that potentially this Middle East demand could offset China. But right now, as Frank talked about, this is just the narrative that's playing out. These are the photos that Nvidia wanted to portray on the Trump's Middle East trip. You asked him a great question. How is Nvidia navigating all this? Well, he's tethering himself to Donald Trump and tagging along every single stop of his Gulf tour. Nvidia, we've seen so far with the Trump administration, has had one loss, the H20 limit in China, but had one huge win. And this was the diffusion rule. When I spoke to Jensen Huang a few weeks ago in Washington, D.C., quickly before I went to see President Trump, the animosity he had to the diffusion rule was palpable. So we'll see how he goes forward and whether or not it's even worth them developing a new China chip.
The stock is up in the pre-market by 0.7%. Look out for a conversation with Jensen Huang later on this afternoon between Bloomberg's Ed Ludlow and Jensen Huang at 6:30 Eastern Time. I want to talk about the bond market briefly as well. Yields higher today, lower yesterday. Yesterday, better news out of Japan, a signal from the Ministry of Finance that maybe they tweak long-term debt issuance. Why? Because when they issued long-term debt issuance today, it didn't go so well on a 40-year maturity. We get some U.S. supply later this afternoon.
We've got 5-year notes today and 7-year notes tomorrow. Overnight, the 40-year bond sale, even after the soothing rhetoric from the Ministry of Finance, had the weakest demand ratio going back to July of 2024. How do you understand the bond market right now? I mean, not to get existential on a Wednesday, but there's this feeling of what is driving it. I mean, if the Ministry of Finance in Japan can't really help things by adjusting supply, are people looking at inflation? Are people looking at the fact that there are only 2 buyers left of Japanese bonds because the Bank of Japan owns them all? I mean, how much are we looking at actual economic dynamics versus supply-demand dynamics? It's a question.
All of them are the above, and not just in the United States. I think Japan is a big feature of that conversation. Debt issuance in the US will be too, particularly what's happening down in Washington, D.C. Elon Musk in focus, pushing back against the president's tax bill in the nation's capital.
And we've heard that as well from senators, where this bill now is going to be sitting with the Senate, and some of them who think that this just spends too much, but it delivers on the president's priorities along the campaign trail. No tax on tips, no tax on overtime, things like that. It is delivering on these promises that he wants to keep. What Elon Musk I found so fascinating is the bill can be big or it can be beautiful, but Jonathan, it can't be either.
Yields right now up by 2 basis points on a 10-year. The 10-year at the moment is 4.46. On a 30-year, up by 2 or 3. Let's call it 4.98. Coming up this hour, David Lebovitz of JP Morgan Asset Management on a policy-driven market. Congressman French Hill on President Trump's big, beautiful bill. And Marissa Adams of HSBC as trade tensions reshape corporate strategies. We begin this hour with stock steady after snapping a 4-day losing streak. David Lebovitz of JP Morgan Asset Management writing, markets remain a prisoner of U.S. policy. While we've reduced our equity overweight in aggregate, we maintain our preference for markets outside of the United States. David joins us now for more. David, good morning to you.
Good morning.
That diversification, that regional diversification, why are you sticking with that story?
So when we look at what's going on with the world, we recognize that policy is the fly in the proverbial ointment. But we do, we have begun to see that, a lot of what people, I think, misunderstood as not being a negotiation tactic actually is a negotiating tactic. And you saw it with Europe over the weekend. You've seen it with China. You've seen it with the UK. And so the way we're thinking about being invested today is we don't necessarily want to subject ourselves to too much policy-driven volatility, but we do believe that the probability of recession has come down meaningfully relative to where it stood at the beginning of April. And so it's really about keeping one foot on either side of the line, having some exposure to risk assets to capture that upside as it materializes, but not having so much risk exposure that the market just moves you around as the headlines dictate the direction of travel.
Yeah, there's a numbing effect. I mean, yes. I feel like at a certain point you start to wonder how much can we really care? And you saw that over the weekend with really muted price action, even with the threatened 50% tariff on European goods. And then at walking back of it, people are like, okay, here we go again. How much can you move past that and look to other catalysts instead of being prisoner to these whipsaws?
Well, what I think is interesting is that you're seeing the market shift its attention towards other, let's just call them pain points, for lack of a better term. What's going on with the bond market with respect to the auctions? What's going on with fiscal policy down in Washington, D.C.? It feels like not only the administration, but investors are trying to move the trade conversation off to stage left and focus the spotlight on other issues that we know are going to be relevant as we move into the end of the year. And so I think they've said, you know what, trade, it's going to be what it's going to be at the end of the day. Let's focus on other issues where we may have a bit more clarity, and things like supply and demand, like you were saying, maybe a bit more of a dictator of the direction of travel.
So which is it within the other buckets, away from trade, since it's so hard to quantify? Is it the supply-demand dynamic with some of the fiscal spending in the bond market, or is it the question of the economic ramifications of some of what we're seeing? I have to mention with trade, but also with some of the fiscal retrenchment that we're seeing from the U.S.
So I think at the end of the day, the way the market is thinking about this is the trade issue is not going away, right? We're going to have tariffs. They are going to be higher than they were at the start of the year. How much higher? Time will tell. The drag from tariffs, though, continues to be pushed out. And what I think the administration is trying to do today is play more of a timing game where if they continue to kick the can on the tariffs towards the end of the year, then the impact on the economy only shows up as you're getting that fiscal thrust in 2026. That's what I believe their plan is. Now, you need to get that timing pretty right in order for it to work, but there is still a narrow path here towards, a better outcome than I think markets are expecting in the base case.
In Trump's first administration, the phase one trade deal negotiations, USTR coming out, that started in 2018. They inked a deal in January of 2020. These trade headlines are going to basically be an overhang on the market the entire 4 years, right?
4 years, potentially. We'll see. It's going to be an overhang for a while. And I think you make a very good point, which is not only did it take time for actual policy to be implemented, but then it takes time for it to show up in the economic data. And everybody who was looking for a soft patch in the third quarter of this year with respect to U.S. growth probably isn't going to see it materialize to the extent that they had anticipated. I think, again, it's going to be more drawn out. That helps smooth the impact from the tariffs overall. And if we are in the process of trading the stick for the carrot and moving more towards fiscal, that could obviously be a net benefit when we get to next year.
But if these trade deals take months and years, what do you make of people coming out and saying we're over peak uncertainty with trade?
So I think that's a fair statement in the sense that, they fired the bazooka and now they're firing cannons. It's a little bit more of a muted approach to negotiating trade policy. The big bang has already been seen, and that's why I think people make that comment. What I think is interesting, though, back to your point earlier, we're trading one uncertainty for another. Right, we're trading trade uncertainty for policy uncertainty and debt market dynamic uncertainty. And frankly, I think those are a little bit easier to digest because there are hard facts and figures that underpin a thesis surrounding those two items.
Is there a price to pay for the volatility of the past 2 months?
So I think that there definitely is a price to pay for the volatility. I think we all have a few scars that we were showing off at the pool over Memorial Day weekend. That's part of why we continue to lean into credit within portfolios. We like the fact that, again, it gives you that upside exposure if things end up being a bit better than expected. You've got a third the volatility of the S&P 500, and you're clipping a coupon of around 7%. And so it's about managing through the volatility rather than running to your bunker and hiding just because volatility has been high.
I think the question the data yesterday introduced, the soft data, the consumer data, is whether actually the soft data might catch up to the hard data instead of the hard data catching down to the soft data. How much confidence would you have in that?
I think that that's a fair it's a fair stance to have in the current environment. I don't think that there's going to be no impact on the hard data, but I don't think that it's going to soften quite as much as what the soft data had previously implied. You can see the resilience coming through, particularly on the consumer side of things, and even on the business side of things. The durable goods report yesterday was very noisy because of what's gone on with aircraft shipments over the past couple of months. But when you hear what businesses are saying, they're not abandoning CapEx that they've already started. No, they're not ramping up investment spending either, but everybody's just kind of standing pat. And I think that that's the point that a lot of people might be missing, is that as we retreat from peak uncertainty, as people have a better understanding of what the playing field is going to look like going forward, they're going to be able to make more informed decisions, right? And if there's one thing that the U.S. economy is, it's dynamic. We saw that during COVID. And so adjusting to the state of play is something that I frankly think we're pretty good at.
I love the way that you frame this, the two buckets of risk, the idea of the fiscal overhang versus trade uncertainty, and the fact that it's by design that these two have an interplay where you shift off trade uncertainty for a while until fiscal can come into play. How does that feature into where you see opportunities, maybe in companies or in sectors that people have underestimated how much resilience there actually will be based on pushing off some of these trade tumultuous moments?
So I think a couple of parts of the market look interesting today. One, we continue to see value in things like technology and communication services. The re-rating and valuation that was observed over the past 6 or 7 weeks was fairly substantial. And so, we're paying a better price. We think the earnings are going to be there. Sure, there's a lot of hype around AI, but it's not something that's necessarily going away. And so comfortable leaning into those growthier parts of the market going forward. The other area that we continue to like is financials. And I think financials are very much underappreciated because we're not talking about one of the other carrots that the administration has dangled, which is the prospect of financial sector deregulation. We were speaking to people during our most recent strategy summit about the state of the financial industry. Are banks ready to lend? It sounds like if they are able to reduce the capital charge significantly or sufficiently, that will open the spigot and really get credit flowing in the U.S. economy, which will just be another tailwind to the overall pace of growth.
David, lots to chew on. Appreciate your time, as always. David Lebovitz of JP Morgan Asset Management with equity futures positive by 0.1%. Stephen Stanley of Santander with this to say on the data yesterday. The book is far from closed on tariffs, but financial markets seem ready to move past it. And these numbers suggest the households may be moving in that direction as well. Equity's doing better in the last 24 hours. With an update on stories elsewhere this morning, here's your Bloomberg Brief with Yahara Arnott. Hey, Yahara.
Hi, John. Macy's shares are higher by 2.5% in the pre-market after the company reported better than expected first quarter results. The retailer maintained its full year sales outlook despite projected tariff impacts, citing its range of merchandise as a key factor. The numbers underscore Macy's efforts to focus on its best performing locations and close struggling stores. Meanwhile, the U.S. government is poised to receive a so-called golden share in U.S. Steel as a condition for allowing Japan's Nippon Steel to acquire the company. Sources telling us here at Bloomberg, the plan would give Washington de facto veto rights on certain company decisions. President Trump announced a partnership between the two companies that included $14 billion in new investments in the U.S., but provided few details beyond that. And Elon Musk will face a lawsuit over his work at Doge. More than a dozen Democratic state attorneys general brought the case, saying Musk wielded illegal power in orchestrating President Trump's cuts in federal government jobs and spending. The judge said the administration adopted a perverse reading of the Constitution with the Doge effort. That's your Bloomberg Brief. John?
Yahara, thank you. More from Yahara later this hour. Up next on the program, the first buddy breaking with the president.
I was disappointed to see the massive spending bill, frankly, which increases the budget deficit, not just decrease it, and undermines the work that the Doge team is doing.
Up next on the program, Monica Guerra of Morgan Stanley, live from New York City this morning. Good morning. Equities up yesterday, up again this morning, just a touch. We're up by 0.1% on the S&P 500. On the Nasdaq, going into earnings from Nvidia later on this afternoon, the Nasdaq 100 positive by 0.2%. Under surveillance this morning, the first buddy breaking with the president.
I was like disappointed to see the massive spending bill, frankly, which increases the budget deficit, not just decrease it, and undermines the work that the Deutsche team is doing. I think a bill can be big or it can be beautiful, but I don't know if it can be both.
Here's the latest this morning. Differences between the president and Elon Musk emerging as the Tesla CEO scales back his work with Doge. Joining us now from Washington is Bloomberg's Tyler Kendall. Tyler, how much do the words of Elon Musk carry weight in the Senate with some of the fiscal hawks out there at the moment?
Yeah, hey, John. Well, it's likely welcome news for the likes of Senator Ron Johnson, a Republican from Wisconsin, considered to be probably the loudest fiscal hawk at the moment, advocating for changes of this House bill. In fact, you had the senator in an interview over the weekend claim that he has enough support to ultimately hold up this bill. But at the end of the day, I have to say, I was on Capitol Hill a lot last week, and the prevailing sense seems to be that front-loading tax cuts will take priority over the spending cut offsets. You already have a range of senators raising concerns about what these spending cuts could look like when it comes to changes to Medicaid and rolling back those clean energy tax credits under the IRA. Now, the CBO their latest analysis, which does not include the final changes to this bill, and we should say the White House broadly disagrees with their methodology, but it says that this House bill would add about $3.8 trillion to the deficit over the next 10 years. And, John, that's before taking into account that Senate Majority Leader John Thune has indicated that they want to make some of those temporary tax provisions permanent going forward.
Tyler Kendall in Washington. Tyler, thank you. To build on those words, on that exchange, Monica Guerra of Morgan Stanley joins us now for more. Monica, good morning.
Good morning.
So we've got the bill that came out of the House, and ultimately we'll see a bill that comes out of the Senate. How wide is the spread going to be between the two?
I think we still have a lot of time to see, but what's interesting is not just a disagreement on how much you're going to add to the deficit, but also which programs are they going to actually look to. So is it IRA spending? Because you have red states that are reliant on some of those tax credits. Is it Medicaid? You know, there's lots of different areas in which they can look to cut and sort of move the needle here. And one of the things that, Elon Musk mentioned, right, is that there's this disappointment that he has that they're still adding to the deficit. Well, if you're going to have significant tax cuts extended, there's really only one way to make up for that difference. Either you cut, significantly from other programs, which is not on the table, or you go to raise revenue. Right. And so that is sort of the hard decisions that Congress is trying to make right now.
Are either of those options on the table when it comes to the upper chamber?
Not on the tax front, right? They're going to have to look for room on the margins. Now, I think you're going to look to adding about $2 to $3 trillion at the end of the day to the deficit. And the way that they could message this is they're reducing deficit spending, so not the actual deficit. And they're going to have to lean into that narrative because no matter how you shake it at this point, they're going to be adding.
Let's get into some of the potential problems. Senator Hawley, Susan Collins, Ron Johnson, who Tyler just mentioned, Medicaid, green energy tax incentives, overall spending. What do you think is going to be the biggest fight when it comes to this bill?
Well, right now it sounds like the fiscal hawk perspective, and each sort of priority is going to get their moment in the sun as they go through these negotiations. But at the end of the day, the thing that markets are going to be looking to is what does that mean for term premiums? Right? Is it we going to get additional pressure because the debt and deficit are out of balance? And so that's something that we have to watch, from a markets lens.
There's a difference between just having a deficit that goes up versus something that really does generate growth, and how much of what we're seeing right now in the proposal is stimulative versus actually contractionary in terms of some of the programs that are being cut.
So the stimulative pieces we think are actually going to come in 2026. What we have from the tax cuts piece is really an extension of status quo. You do get some wiggle room on CapEx, on R&D, right, as far as different tax incentives for more of the growth side, right, of the economy. But that actually dovetails really nicely with potential deregulation and fiscal spending for things like data centers, AI, potentially clean energy, if you're thinking about other, I would say on the growth sector winners.
How much risk is being foisted to the states, to specific states? You talked about how certain programs, if they get cut, have a disproportionate effect on specific regions. Just how big is that disparity? What are you seeing there?
Yeah, so it's not just the federal deficit. It's also at the state level. So our head of municipal research, Mark Schmidt, he's put out some great work on this, really highlighting that credit spreads are likely to be pressured for nonprofit healthcare, especially if you get that Medicaid cut. And that's really on the single names and rural hospitals, but then also at the state level. If you're thinking about the way that states are going to have to step up and carry some of this burden, because people still need healthcare, regardless if you cut their benefits or not. And so you have to look to states that have, an imbalance with their general fund and reserves. And places you could look to would be California. New York would probably, weather the storm well, but also some rural states that may see an influx of folks who are rolling off Medicaid in addition to the cuts.
Are you starting to see that market impact already play out?
So where we're seeing it is actually more in the non-for-profit healthcare space. Now, with states, they're a much slower moving juggernaut. And so that really you have to wait until the end of the year, see how they, all their tax revenues come in, et cetera. And then it becomes a question around how much pressure they're going to have to build. So really where you're seeing spreads tighten is around non-for-profit healthcare and other municipal categories.
Will tariff revenues offset any of this?
Tariff revenues, the idea is that they will offset, at least from the federal component. Now, do the states benefit? Not directly, right? Because if you're thinking about how tariffs are paid by the business owners, that goes directly to the federal government. So you're not going to see a revenue boost from tariffs directly to the states. So that is a no-go.
There's one part of this bill we haven't discussed yet, which I think is important because it could be on the chopping block, and that's the 40,000 new cap when it comes to salt. Do you think that stays?
I think you get maybe a reduced level. This is something that you have to remember that they're going to go to a conference over. So you're going to have House leadership and Senate leadership together trying to get all these disparate goals and realign around them. So maybe we end up at that 30,000 where we started. That would be, I think, in the realm of possibility.
But does a Mike Lawler or Lee Stefanik have a single friend in the Senate when it comes to keeping the tax deduction higher?
No, I don't know the inside baseball on those relationships. I want to be clear about that. But what I do know is that they really were holding up the process in the House. And if you want to get full consensus around this and have something sent in a timely manner to the president, there may have to be some concessions made. I'm not ready to call that it's going to be completely off the table yet.
Do you think it gets done by July 4th?
I think you get a blueprint by July 4th, so no.
OK. Monica Guerra there of Morgan Stanley. That's certainly the goal, to get this wrapped up by Independence Day.
And that is directly correlated to the July 9th, also deadline for some of these trade negotiations, because these are part and parcel to offset one another, which really raises the question, how stimulative is this bill going to be on the fiscal side, and will it be quickly enough to offset some of the hit from some of those tariffs?
Yeah, and one thing we've explored on this programme over the last few days, whether that bill, if it does get signed by July 4th, emboldens the president to go harder on some of the trade issues too.
Well, potentially. I think a lot of this we also have to remember, we've seen the president have these reprieves when it comes to trade, depending on the pushback on the market. So I think you want to see where the 10-year yield is trading on July 5th. I think we're off that day, whatever day we're back on air, and where the markets are, because that has been actually a pushback when it comes to how far he's gone on the tariff front.
And to figure that out, you might have to look to Japan. Overnight, 40-year debt issue out of Japan coming in a bit weaker than expected, triggering a bit of a sell-off in treasuries. Yields are higher by some 2 basis points on a 10-year, up by 2 on a 30-year. Later on, some issuance, the 5-year. On to tomorrow, the 7-year. That's the debt situation. In the equity market, the focus on Nvidia earnings after the closing bell, with equity futures on the S&P 500 just about unchanged. Jensen Huang seems to be the man of the moment. What will the numbers look like later?
And how much can he message in this conciliatory fashion that the trade uncertainty is not bothering him? He's okay with it. If you don't want my H20 chip, I've got an H25 chip or whatever else the new thing is going to be, and really push forward this sense of leadership in the chip sector.
Jensen Huang on Bloomberg TV, 6:30 p.m. Eastern Time, sitting down with Bloomberg's Ed Ludlow. Look out for that. Up next on this program, Congressman French Hill, as President Trump's signature bill faces more hurdles. From New York, this is Bloomberg. Snapped a 4-day slide on the S&P 500 in yesterday's session, a solid gain of 2% to kick off the trading week. Equity futures just a touch higher, an inch higher, up by not even 1/10% on the S&P. With 2 hours until the cash open, let's get you some morning movers. Here's Danny Berger. Hey, Danny.
Hey, John. We had some retail earnings in the past hour. Let's go through them. Dick's Sporting Goods, one of them, up 1.3%, a quarter where they basically reaffirmed everything that we got from them earlier this month. That's enough, though, to send shares higher. Really, the concentration, though, for Dick's has been their acquisition of Foot Locker, which is why they pre-announced. They announced that deal and what the results would be, where they keep their outlook the same. That's really going to be the concentration of that call, what Dick's Sporting Goods looks like with Foot Locker now in tow. Now, we also heard from Capri, that is the owner of Michael Kors, of Jimmy Choo. Those shares slightly weaker, down 1/3%. I got to say, this is a market that's had a hard time making sense of what the earnings look like and how to treat them. The stock was down when it first reported. It was up as much as 6% at one point in the pre-market. Again, now slightly weaker. Current quarter better than expected, but it cut its outlook from about $4.1 billion in revenue to $3.4 for this fiscal year, saying that they would have to give a range of outlooks because of the uncertainty, because of tariffs and what that means for consumer spending, something we keep hearing time and time again. Macy's, meanwhile, that is slightly higher, 0.6%, another volatile pre-market session for them. Again, this quarter beats. The CEO saying that their turnaround strategy to concentrate on the stores that are doing well is working. However, they did lower their profitability outlook for the year. And you guessed it, they said it was because of tariffs, because of uncertainty, and some of the discounting that might come because of that, John.
Macro dynamics, as they all like to say.
Yep.
Danny, appreciate it. The stock is up by close to 0.7%. On our radar this morning, NVIDIA earnings after the closing bell. Investors waiting for updates about AI spending and how China export controls could weigh on the chip giant.
Yeah, how do they talk about tariffs? How do they talk about the strategy when it comes to international sales and how much they weigh in on the macroeconomic dynamics or the conversation, as some people will just say? I'm also curious to see the supply-demand dynamic. What are we going to be talking about more? Supply chain inability to actually meet demand, or demand questions, particularly when it comes to hyperscalers that are their biggest customers that are increasingly becoming their biggest competitors?
I love what David Lebovitz said in terms of markets are a prisoner of policy. Don't you feel that that is really true for NVIDIA when it comes to what they can sell, cannot sell to China, and whether or not they can make up the market share based off what the president is doing with policy in other places in the world, like the Middle East?
In many ways, for many companies and many asset classes, the fate of those are in the hands of the policy of the President of the United States. And we've seen that repeatedly over the last 2 months.
Which makes it very difficult to do anything. And it makes it very difficult to really take longer-term actions. Nonetheless, a lot of companies are gleaning some insight from what we've seen recently, which is that this is a president that likes deals. So how do you get a deal done? And I love what Ed Mills said. I'm going to keep repeating this, which is as long as market participants can sniff out an element of capitalism and not ideology, they will be happy.
They'll take that and run with it. NVIDIA's up this morning by 0.6%. Some of this also affects Chevron. The Trump administration issuing a stripped-down license to Chevron, allowing it to continue minimal operations in Venezuela. Chevron will be able to conduct equipment maintenance, but won't be able to produce oil in the sanctioned South American nation.
So this is interesting because this is getting a lot of behind-the-scenes debate within the Trump administration. You had Secretary of State, also the National Security Advisor, now basically saying that they were going to let this license lapse after you had Rick Cornell, who's this special envoy for the president, actually meet with some Venezuelan officials when he returned a U.S. veteran, going on a podcast and saying, we will give a license. In the end, Rick Cornell actually won, and they were able to get this license. But I wonder if this is one of the last few that this administration is willing to do with Venezuela, or potentially if this means talks can continue with the Maduro regime.
We talked to Mike Worth directly about this issue. This is not the volatility I'm sure that he was looking for. I wanted to squeeze this story in. This one is doing the rounds today. A new warning about the impact of AI on the job market. The Anthropic CEO telling Axios AI could wipe out half of all entry-level white-collar jobs in the next 5 years. The CEO adding firms and the government should stop, quote, sugarcoating what's coming.
Why would you have an entry-level person to come in and do data accumulation or even data entry if you could have some kind of computer program do it? This has to do with both computer programming itself, as well as legal tasks, as well as banking tasks, deal documents, etc. Here's the question, and it's not all gloom and doom for people who are saying, why bother with anything? Why go to school? I'm just going to go to a farm and farm stuff, which actually sounds great. It's also talking about what you can do to get ahead of it so that a group of people are not increasingly irrelevant in their ability to use some of these tools to augment their current jobs rather than just be completely displaced by them because what they have to offer is so similar.
Steve Bannon, which is this MAGA podcast, has been talking about this for a while, how AI is going to ruin all these jobs. And he said this is going to be a huge political issue for the next 4-8 years when it comes to the presidential race. Because right now, it feels like Washington at the moment is turning a blind eye to all of this because they're inking deals in this space.
Upward mobility is a big feature of American psyche and the American culture. You lose that and become dependent on UBI. I don't want to be dependent on universal basic income and the government and these people that we have to elect being in control of how much we earn and how much we spend.
So this is really the right question to be asking, which is, do you end up concentrating wealth disproportionately in a smaller and smaller group of people who know how to capitalize on some of the efficiencies from artificial intelligence to maximize their wealth at the expense of other people having jobs and having the upward mobility? Is it okay just to placate people with some basic level of income? A lot of people say absolutely not. Everybody needs to feel like they're needed in society. So how do you do that? And to your point, Annmarie, how do you get some sort of political discussion around what that looks like, whether it's education, whether it's some sort of information campaign of the skills needed in schools? And we see that. Teachers are grappling with that. I see that at home every single day. How do you deploy ChatGPT type skills without replacing the need to learn, to critically think, to write research papers and do your homework?
Unfortunately, at the moment, it's Operation Ostrich, head in the sand and hope for the best, which is probably not the best thing to do.
It's quite the opposite. You actually have to get ahead of this, and it's a conversation that needs to be had, but we are talking about other things every day. So maybe at some point we'll have that conversation.
We'll come back to this story later on. Let's turn to Capitol Hill. President Trump's big, beautiful bill set to face hurdles and undergo significant changes in the Senate after passing by a narrow majority in the House. Joining us now, the Republican Congressman French Hill of Arkansas. Congressman Hill, welcome back to the programme, sir. Let's get into this. I want to understand. So here on Wall Street, as you know, there's a big sense of self-importance. When you put this bill together, how much attention do you pay to the bond market, fixed income, and what's happening on Wall Street?
Well, Jonathan, great to be with you. Look, Republicans in the House and Senate have collaborated for over a year on the components of this bill, and certainly very intensely since the election. We wanted to deliver on President Trump's campaign promises. First, redeploy federal spending, cut out some of the federal spending that we don't particularly agree with, and reinvest in the border and reinvest in defense. And secondly, block a 22% tax increase on families by extending the Tax Cuts and Jobs Act. Those were the fundamental components. And we did believe that between the Trump regulatory policies and growth policies and tax policies that we would get some acceleration in economic growth from the provisions in the tax code. But we also focused on cutting spending. And in the House bill, we cut $1.5 trillion in spending over the next 10 years.
Congressman, there's a handful of vocal senators already who want major changes to this bill. Is it going to look remotely like anything you sent over to the Senate?
Well, I'm not going to make predictions about what will happen in the Senate. We legislate every single day in the House. They legislate periodically over in the Senate. And so when they do, they have a lot of concentrated effort on it. They have to work by consensus in the two parties there, even more so than we do in the House. So I don't want to predict that. But look, I want to be clear that John Thune and Mike Johnson and President Trump have collaborated on the background and details of these bills. And that's why, based on what I've witnessed in the House over the last 5 months, I want to echo Speaker Mike Johnson's point, which is this is a delicate dance and a delicate balance. And so the Senate has to consider any major changes very, very carefully, I think.
Can a bill be big, or can it be beautiful, or can it be both?
Well, when you've got President Trump, you've got both at all times. So I think it can be significant in its policy direction and change, as well as very beneficial to American families and the growth of the American economy. And I think that's delineated in the scope of the bill that we passed in the House.
Congressman, of course, Annmarie was talking and referencing what Elon Musk was talking about as he seemed to distance himself, saying he's a bit disappointed that the current iteration of the bill does increase the deficit, and as he said, it seems to undermine some of the progress made by efforts in Doge. Do you agree? Does it concern you that there is this increase in the deficit without real offsets for the longer term?
Well, I think the work by Doge over the first 5 months of them has done a lot to uncover productivity loss, need for reform and full-time equivalent positions, how to reform IT systems, make them more reliable, reduce waste, fraud, and abuse. All those things found by Doge are helpful. And I think they inform Chairman Tom Cole, the chairman of the House Appropriations Committee, and his colleagues exactly how to better focus FY26 spending. When we get back into session next week, you'll see the hearings in the House Appropriations Committee start quickly, and I think that's where the Doge work will be best reflected, is in looking at FY26.
Do you think that the current iteration of the bill does enough to juice growth to offset some of the constraints that you're seeing with tariffs, with the idea that even Walmart in your home state in Bentonville is being told eat it, and you're seeing profit margins contract or expectations for it? If you have both the deficit increasing and you have the potential for companies having to cut back, does that worry you?
Well, as I've said on your show before, I remain concerned about the uncertainty in the tariff strategy. I think we've got regulatory reform going absolutely in the right direction. I believe that the tax preservation of no cuts for households and tax incentives for business are good in the bill, including major tax incentives to bring a new plant and facilities to the United States for construction. But we need to make sure we have clarity on the tariff issue. And you're right, Doug McMillon, the CEO of Walmart, met with President Trump, made it very clear to him how quickly he believes that tariff clarity needs to be found, or it's going to impact store shelves and store prices across the country. And I think you've seen that reflected in the Macy's report that you had just a few minutes ago.
Did you get a sense, speaking to a Walmart congressman, that we will get clarity by July 9th?
Well, I believe that what I've heard from business, Dillard's department store here in Little Rock, Arkansas, one of the biggest retailers in the South, Walmart headquartered in Bentonville, Arkansas, as well as a number of small manufacturers here in the state and large, that they want clarity soon, meaning May, June, early July, because that's going to really impact planned shipments, planned purchases, and what's going to be on the shelves for back to school and this fall. So it's very important, particularly in the retailing industry. Other industries in manufacturing, maybe there's a little bit more leeway based on inventories that's been built over the first few months of this year.
Congressman, just before you go, I have a feeling you might want to weigh in on this. The Anthropic CEO and what he had to say to Axios, that AI could wipe out half of all entry-level white-collar jobs. Are we sleepwalking into a bit of a disaster?
Well, I served last year on the Speaker Johnson's bipartisan full House AI task force. We had hearings all year from every segment and walk of life, from education to healthcare to service businesses. And we came up with a series of principles. And one is you have to keep a human in the loop in applying AI, either internally or externally in a business application or a government application. And if you use it as a tool, I think it's going to be a very big productivity tool to boost economic output. And from what we heard in testimony, I didn't hear the Armageddon approach in the short run because it's such a emerging early stage tool. It's accelerating rapidly, but I think if we keep a human in the loop as we apply it internally and externally in our businesses and in government, that we're going to continue to have employees that use it effectively, and that it's not going to be as catastrophic in the short run, particularly as that prediction.
We hope you're right, sir. Congressman Hill, it's good to see you, as always. Congressman French Hill there on the latest news this morning. The AI predictions out there at the moment, and the latest down in Washington, D.C. with the tax bill.
We just ended on a point, though, that is important, which is the short run. It doesn't seem like it's catastrophic. In the medium and longer term, how do you maintain that people catch up with technology that is moving at a light speed. It seems like every technological cycle has been expedited. If we're talking about what happened with globalization and the hollowing out of industrial centers, well, do you get the same kind of reaction in certain white-collar jobs over a shorter period of time just simply because of how quickly this is moving?
But every time you talk to someone in the AI space or an AI executive, what they say is that, oh, no, you're just going to be more productive. You won't lose your job. You'll just be more productive at your current job. What Anthropic is saying is that you're not even going to have the entry-level positions anymore for anyone sub 30 years old to get on the ladder when it comes to labor force.
It's a fear that I've had for quite a while, and you echoed it just then. Will AI do to services what globalization did to manufacturing? And that's the ultimate fear that I and many others have too. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Let's cross over to Yahara. Hey, Yahara.
Hi, John. We start with the latest retailer to report, Abercrombie & Fitch. Those shares are surging up nearly 25% in the pre-market. The company reported net sales and adjusted EPS that beat estimates and announced it repurchased $200 million worth of shares. Abercrombie also raised its full-year sales forecast in accordance with current tariff levels, but did exclude levies that remain paused. Meanwhile, President Trump said Canada could join his proposed Golden Dome system for $61 billion. Canadian Prime Minister Mark Carney confirmed the country is considering joining the U.S. on the project, but says discussions are still at early stages. President Trump also proposed letting Canada join for free if it becomes the 51st state. Quite the condition. And in sports, the Indiana Pacers are one win away from the NBA Finals after beating the Knicks at home in Game 5. Pacers star Tyrese Halliburton had a historic performance, recording a 32-point triple-double without a single turnover. The series returns to Madison Square Garden on Thursday, where the Knicks need to win to avoid elimination. That's your Bloomberg Brief. John?
Yahara, thank you. Pretending that game didn't happen. Up next on the program, looking past Trump's tariffs.
A 10% rate is not huge enough to have any adverse consequences in the economy. It's similar to a 10% move in exchange rate.
How do you navigate all of this? We'll catch up with Marissa Adams of HSBC in just a moment. Equity futures pretty stable here, just about unchanged on the S&P. The main event later on this afternoon, earnings from Nvidia. After the closing bell, Nasdaq 100 futures positive by 0.15%. Under surveillance this morning, looking past Trump's tariffs.
A 10% rate is not huge enough to have any adverse consequences in the economy. It's similar to, it's not exactly the same thing as a 10% move in exchange rate, but things like that happen all the time. And, you know, they have an effect on the economy, and then they move on and they pass.
Here's the latest this morning. HSBC's Trade Pulse survey finding 93% of US firms feel confident in their ability to expand international trade over the next 2 years, despite current trade barriers. Marissa Adams of HSBC is the regional head of Global Trade Solutions and joins us now for more. Marissa, welcome to this program. That is quite a number. 93% of firms feeling confident in their ability to expand international trade. Can you tell us if they're following that up with investment decisions?
Thank you so much, Jonathan, for having me this morning. And we were really excited, actually, about this result. So we surveyed over 5,700 corporates, over 1,000 here in the United States. And in fact, as you know, 93% of them are confident in trading internationally, even in the current tariff disruption. And what we've seen is that U.S. companies are really resilient. They're doubling down on creativity, on innovation, how they can innovate their own supply chains, as well as invest in new technology. What we are seeing from an investment perspective, though, is that they're in a wait and watch period. You know, it's only been 7-8 weeks since the tariffs were announced, and they're starting to see some of those costs come through, but they're in a wait and watch period as to how they operate next and where their next investment moves will be.
What's driving this optimism given the uncertainty in Washington?
It's a really great question. And I think you've obviously seen from some of the results this morning and looking at your previous guest from yesterday, 10% is something that clients and corporates can absorb. And I think that one of the things they've really looked at is how they explore new markets. You also saw with a lot of corporates, both in the United States, but also abroad, was that they had the experience of COVID, where they really were able to look at their supply side, see where they could build resiliency. Now, in the current environment, they're looking at how they look at new demand markets. So it was an interesting result. What I would say is that we're only 6-7 weeks in, and we'll start to see, and this is a sentiment survey rather than anything else.
One key finding you have is the majority of these companies reported higher operating costs because of the tariffs. How does it look year end? Are those costs going up?
It really depends industry by industry. So clearly you have industries like consumer retail, which have a shorter order cycle, and they will start to see those costs come quickly, versus in the industrial sector or energy, they're longer term contracts moving through. But as I said, that 10% tariff doesn't look like it's going away. So therefore, that baseline will be there. I think there's two other things that are really interesting and we've seen in our conversations with customers. The first is that many customers, and there's so many goods that weren't tariffed previously, have never gone through a customs process. And that's costly in itself. And in fact, we actually HSBC launched Trade Pay for import duties, which is a product where actually we will pay the import duties to U.S. Customs and Border Protection or to the customs broker on behalf of our client, and then finance that for the period that the client needs, because you pay at the point of entry rather than the point of sale. So you have a working capital gap. The second thing is on the supply side, where we've seen in certain industries, particularly consumer retail, some of the tech space, where corporates quickly moved supply to different countries earlier. And as a result, some of their key suppliers actually saw more demand and therefore increased cost as well. So we're seeing it on all those sides.
How complicated, Marissa, is it? I want you just to build on this idea of dealing with customs agents and dealing with policies that shift overnight, over the weekend, on a given day. How difficult is it for people to keep up, and what's the enforcement like on the part of some of these agents?
Well, I can't speak to the enforcement, but I can speak to the fact that it differs from two different types of companies. So if you look at larger companies, they had the experience of COVID where they really built up their supply chains. They looked at the resiliency, and actually they have larger teams able to cope with this. So in some ways, those corporates are better prepared. On the flip side, smaller companies are a little bit more agile, so they can move quicker to new routes and new supplies. So it's really a tale of two halves. And actually, on that front, both sides are succeeding. One, because they have the experience of COVID and that investment. But on the other side, the smaller corporates are able to be a bit more agile and move where they need to.
Just quickly, Marissa, how much are companies investing in domestic production, whether it's in the United States or elsewhere, to just avoid having to deal with this at all?
Well, look, we've seen over the past 7 years or so a lot of investment in different industries around bringing supply, bringing production closer to home. In some ways, actually splitting production. So if you look at these corporates, as I say, the 1,000 that we surveyed in the U.S. are all internationally active. So they have domestic markets, but also international markets. And in many ways, what they're doing is actually moving production closer to those consumers. But it isn't an easy task. And we've seen over the past 7 years that actually supply chains have gotten longer, not shorter. You might have brought the assembly back closer into the United States or in another country closer to the actual domestic supply. But fundamentally, the raw materials are still coming from the same places.
Marissa, this was fantastic. Let's do it again soon. Marissa Adams there of HSBC on trade finance and what's happening with supply chains at the moment. Great to see that confidence. Fantastic to see that confidence. Not so good to see that wait-and-see mode. We're still waiting and waiting to see what happens.
They've got confidence that global trade isn't going anywhere, and we've already seen that because global trade has sustained at levels that might be less efficient but are still there. The question is, where do you move it? What do you do with it? How do you even keep track of some of the changes, let alone figure out how to comply with all of these regulations?
To your point, policy can change overnight. Call HSBC seems to be the answer there, apparently. Equity futures at the moment positive by 0.1%. Up next, Aaron Kennon of Clear Harbor Asset Management, Gil Luria of D.A. Davidson, Nancy Lazar of Piper Sandler, and Meghan Robson of BNP Paribas. The third hour of Bloomberg Surveillance is coming up next.
There is a risk premium for U.S. assets that was not there before.
Investors should be overweighting or certainly exposed to non-U.S. markets.
We're having our usual bulls versus bears debate.
This notion of U.S. exceptionalism being over is a narrative. I don't buy it.
There's nothing that beats our capital markets. They continue to be the envy of a world.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
A nice pro-American start to the third hour of Bloomberg Surveillance this morning. Good morning to you all. Equity futures on the S&P 500 positive by 0.1%. On the Nasdaq 100 positive by 0.2%. They're the scores at the index level. Later on this afternoon, the focus on one single name. Finally, wrapping up earnings season for the Mag 7 with NVIDIA.
Yeah, you talk about the pro-American start to the show. The pillars of American exceptionalism were built in large part on technology, in large part on NVIDIA, that has been whipsawed as much as the narrative has been around whether it's on or whether it's off in terms of U.S. exceptionalism. A real question of how they shift the narrative after the bell today when they report earnings. Do they lean into the tariffs and the rearranging of potential customer base? Do they lean into AI and just how quickly it is evolving? Or do they lean into the fact that they cannot meet demand still because of just the lack of chips and the lack of production availability?
Even if they are concerned with policy in Washington, they're not going to be very blatant about it. They're not going to be so direct about it because they don't want to have the ire of this president when it comes to what is going on in the chip sector. We had two different views going into this. Frank Lee of HSBC talked to us, and he said there is a narrative that shows that the Middle East could be an offset. When it comes to Morgan Stanley, though, they say there's no offset right now that they can see for what's going on, and the fact that the curbs for China and the walls have gone up for their H20 chip when it comes to Beijing.
You mentioned Frank Lee of HSBC, saying you won't get that beat and raise quarter that we were used to over the last several years. NVIDIA's up in the pre-market at the moment. The Anthropic CEO is the guy in AI making all the headlines this morning, speaking to Axios, warning, can I call this like employment Armageddon? Saying that unemployment could spike to 10 to 20%. We could wipe out half of white-collar entry-level jobs. That is kind of employment Armageddon.
Talking and voicing concerns as he unveiled some of the new technologies that his artificial intelligence machine learning programs could achieve. It raises a question of whether we're having the right conversation. It's not saying don't use these tools. These are absolutely productivity enhancements that could have great gains. We could cure cancer. We could make our jobs much more pleasant. We could potentially improve the way that we deliver childcare and health care. There is a question, though, of how many people get left out in a transition and whether it's being discussed in the correct way. I don't think that Jensen Huang's going to be talking about that today, but to see the speed at which people are adapting to some of these technologies might give you a sense of how quickly we need to expedite this conversation.
We often take the opportunity to thank the audience at home. I often say, you've heard me say it on this program, we have the smartest audience on the planet. Thank you. Proof of that. Someone writes in, AI is certainly going to impact all sectors, but we shouldn't be too quick to discount the value of having a human around to blame if something goes wrong.
I think that's actually very valid. I mean, let's be honest. There's no better scapegoat than a human who can say, I didn't do it.
They're going to blame Washington. Where were you? Behind the eight ball. Washington is years behind where the technology is in terms of getting ahead of this, and honestly, what could be huge political fallout.
A massive thank you to that Bloomberg subscriber, who I won't name. Coming up on this program, Aaron Kennon of Clear Harbour is going to join us as stocks snap 4 days of losses. Luria of D.A. Davidson looking ahead to earnings from NVIDIA, and Nancy Lazar of Piper Sandler on the resilience of the U.S. consumer. We begin this hour with stock steady as risk appetite takes a breather. Aaron Kennon of Clear Harbour Asset Management writing, the abrupt shift in the administration's approach to negotiating can lead to high bouts of volatility. With that said, we continue to believe there are opportunities across the investment landscape. Aaron joins us now for more. Aaron, welcome back, sir. Let's talk about that word. Opportunities. Where are they right now?
Well, certainly, if you look across the equity landscape, you were just focusing on AI. We still think that there's a rather significant build out ahead, and that really this idea that, you know, the data center hyperscaler spend is peaking in 2025, and that therefore there's no investment opportunity beyond that because we're just going to see a rate of change that's decelerating. I think really, you know, it misses the broader point, which is that there's going to be great opportunity and productivity gains within the equity landscape across software. Semiconductors may become more commoditized in this debate, but the design of semiconductors, the build out of the data centers, the cooling of the data centers, the need for electricity. You know, the IEA put out a report that projects that electricity demand just due to data center expansion is going to double by 2030, and that in the United States, between now and 2030, our demand for electricity is half of that demand growth is going to come from data center growth. So there's huge opportunities across the energy landscape, the infrastructure landscape, and then of course the technology landscape. And then of course, more broadly, if you look overseas, we think there's huge opportunities still in Europe, We think there's an opportunity in Japan. There's a lot of reshoring of capital there, and you've been discussing that as it pertains to the long bond, and then the rising middle class in the emerging markets. So we think there are some very macro strong tailwinds ahead of us.
Let's pick out two of them. So let's deal with tech, and then we'll get to the debt market. Let's deal with tech first, with NVIDIA earnings coming up a little bit later. The benefits of the technological progress, from the stock perspective, will they be concentrated in the big tech names, the Mag 7, or will we see those benefits more pronounced in the S&P 493 in the years to come?
You know, my view is we're going to see a broadening, and I think that broadening is because you're going to see the trickle-down benefits of the build-out, and the recipients of the build-out will be the hyperscalers and the data centers in the early innings, and then the latter innings we're going to see the trickle-down benefits permeating the manufacturing floor. You know, we used to talk about lean manufacturing. You apply AI and robotics, it takes it to a different level. You think about sort of the hospitality sector and applying AI there, or healthcare, as you referenced earlier, in AI as it pertains to robotics, and increasing hygiene and increasing outcomes in a more positive way. So we think there's just a huge opportunity set in that regard.
Aaron, it really raises the question about whether the risk is shifting away from the stock market into the bond market. If you have margin improvements over the long term, not necessarily the short term, if you have efficiency, productivity gains at a lot of company corporate levels, at the same time that you have a real churn on just the base of people who live in a country, and this question about the overhang of debt, do you see a better, less risky prospect in stocks right now than in government bonds?
Well, you know, one is not able to live without the other, and the cost of capital certainly impacts the vast majority of the equity market, and we always have to keep that in mind. But, you know, if you think about, you know, the glass half full component, I mentioned Japan earlier, when you have rates trending higher, that yen carry trade disappears. Capital is brought back to Japan. It's not just Mr. and Mrs. Watanabe's capital, it's also institutional capital. And so that reshoring can augur very positive tailwinds for the financial sector and also for other areas of the economy. But for certain, in the United States, we should be concerned about higher deficits and what it means for the long end of the curve. But we should also keep in mind, too, that the average maturity of the outstanding U.S. Treasury profile that exists here in the United States, our $36 trillion debt, is about 5.5, 6 years. It's not the long bond. It's not 30 years. That's about 17% of our outstanding Treasury debt. And I think we need to keep that in mind as well.
What's driving the bond market? And I mean, you reference this question of issuance and maturities. Is that the issue? Is it inflation? Is it some sort of shift of cash away from U.S. markets to domestic markets, as you were referencing with Japan?
I think it's multivariable, Lisa, to be honest with you. I think it's a concern at the end of the day. If you look at countries where we have a trade deficit, are not just, you know, buying our treasuries because they like us. They're buying our treasuries because they're trading with us. And if there's a tendency for us to trade on the margin a little less with countries where we have trade deficits, they're going to have less incentive to own treasuries. So that would be a little bit of a headwind. Our deficit projections at 7-8% deficit to GDP, that's not a positive tailwind, particularly for the long end of the curve. The front end of the curve is more controlled by the Fed, as we know. And so that's why we have, you know, a rather significant disparity right now between, you know, front end yields and long end yields. But, you know, multifactorial for sure.
You're touching on a really important dynamic, though, a really important process, Aaron, which is at the moment we don't want their exports, but we want their capital. Can we have one without the other?
Well, I think this is a wake-up call to that reality, and I think there may be a longer-term thought that maybe the savings rate in the United States can move up so that what happened in Japan since the late 80s through about now, which is that the savings rate really rose markedly, even though it's a developed nation, could somehow be reflected back here in the United States where individuals start to save more and buy more in the form of treasuries. I think we're a long way away from that right now, and I think that's one of the challenges. You know, every 75 basis point rise in the total weighted average cost of our treasuries is about $275 billion. I mean, that was our Navy budget last year. So big challenges if we don't get this under control.
Well, for every spending, every $7, one of those dollars in the U.S. spending goes to paying off our net interest. Amidst all this policy uncertainty in Washington, of course, we have the One Big Beautiful Bill as well. Do you find that this bill is a tailwind or a headwind at the moment?
Well, in the short term, when you look at where we thought it was going to be 2 months ago, it's now representing stimulus, where we thought it was going to represent more of a Doge-lined, sort of bit of hawkishness. And maybe contraction. And that's why I think some of the commentary just a few weeks ago and months ago, and I was articulating this, was, well, we're going to have a lot of stimulus in Europe, but we're not going to have a lot of stimulus coming out of this bill in the United States. And so therefore, maybe you want to reallocate capital to European equities. Well, we're going to have about $300 billion of stimulus if this bill passes. I think in the long run, though, will this create a Liz Truss moment? In the short to medium term, which is going to cause problems for a deficit in the long run? We'll have to see. Will those bond market vigilantes come home to roost?
Just to jump in here, what do you really see as stimulative? Because isn't this just an extension of current policy?
Yeah, I think if you look at, some of the extension of part of the IRA, it's still stimulative. You're right. If you look at the extension of the Tax and Jobs Act, it's still it's about as is. But if you look at the provisions around interest for your property taxes at the local level and the increase in standard deduction, things like that, it's incrementally stimulative. I think it's considered about $300 billion the last I saw. But again, those senators are there are 3, 4, 5 Republican senators who are a no-go on this. So a lot can change between now and, let's say, the vote.
Aaron, appreciate your time, sir. A lot can change. Aaron Kennon there of Clear Harbor Asset Management. Finishing things up there on the bill, working its way through Congress. Equity futures this morning, positive by 0.1% on the S&P. That's the price action. For an update on stories elsewhere this morning with your Bloomberg Brief, here's Yahara Anand. Hey, Yahara.
Hi, John. Elon Musk will face a lawsuit over his work at Doge. More than a dozen Democratic state attorneys general brought the case, saying Musk wielded illegal power in orchestrating President Trump's cuts in federal government jobs and spending. The judge said the administration adopted a perverse reading of the Constitution with the Doge effort. Meanwhile, the Trump administration is raising the stakes in its ongoing battle with Harvard and other universities. Secretary of State Marco Rubio ordered U.S. embassies worldwide to stop scheduling interviews for student visas. This comes as the U.S. considers stricter vetting of applicants' social media profiles. And in sports, LA Dodgers phenom Shohei Ohtani became MLB's first player to reach 20 home runs this season. He's now just the third Dodger ever to reach the mark within just 55 games. Plus, it marks the third time ever that Ohtani has homered in 3 straight games. The milestones came in a 9-5 Dodgers win over Cleveland. That's your Bloomberg Brief. John?
Absolute animal. Unreal. Yahara, thank you. Up next on the programme, the Morning Calls Plus. Gil Luria of D.A. Davidson with all eyes on earnings from NVIDIA. The opening bell 1 hour and 14 minutes away. Equities positive by 0.1% on the S&P, up by close to 0.3 on the Nasdaq. Coming up a little bit later in the bond market, the focus will be on $70 billion of 5-year notes. Tomorrow, $44 billion of 7-year notes. The 5-year piece of the curve is a section on the curve where a lot of people have liked being over the last several months, so that's one to watch.
Here's how the conversation goes. Do you like 30-year bonds? No, no, no. We prefer the belly of the curve, 5 to 7 year duration we feel comfortable with, which is what everyone has been saying. So maybe you get a bid into this one, a little bit softer, the 7-year. This is what to watch, though, the increasing aversion to taking long-duration risk across developed markets.
Let's see how that goes a little bit later on this afternoon. At the moment, the 5-year is just about unchanged on the session. Likewise, rise on the 7. That's the price action for some morning calls. First up, Goldman Sachs downgrading Booz Allen Hamilton to sell, seeing limited medium-term revenue growth due to pressure on federal civilian budgets. That stock is down by 2.4%. Your second call from UBS lowering its price target on FedEx to $3.11, citing a likely more volatile and weaker fourth quarter business backdrop. That name is down by 0.4%. And your third and final call from Melius Research, raising its price target on Broadcom to $283, saying the company is positioned to see accelerating sales in AI semis. That name is up by about 1 full percentage point. Sticking with chips, NVIDIA earnings coming after the closing bell. Investors are waiting updates about AI spending and how China export controls could weigh on the chip giant. Joining us now is Gil Luria of D.A. Davidson. Gil, welcome back to the program, sir. What's the number one focus for you later on this afternoon?
China. We really don't know what the level of restrictions are on NVIDIA selling chips into China, which chips they can sell, when can they start selling them, can they sell them to any Chinese company, can they sell them into China? We really don't know the answer to that. And even though NVIDIA reports that only 13% of their sales go to China, those are direct sales to that are invoiced from China. We actually suspect it's more like a quarter of their revenue goes there. And that's the highest level of uncertainty. We know they took a big write down earlier in the quarter, $5.5 billion. That represents at least $15 billion of sales. And we know that there's legislation coming to further restrict them, regulation coming to further restrict them. So we really want to hear from them, what chips can they sell into China and when can they start selling them?
Out of interest, how many of their chips do you think end up there anyway? With the DeepSeek renovation at the start of this year, Gil, there was something that Jensen Huang and NVIDIA said. They said it was amazing to see, basically, I'm paraphrasing, and it was export compliant. How many of their chips just end up in China anyway?
So when the 13% is direct sales into China, we believe those represent the H20 chips that they used to be able to sell. We suspect that just as much arrives in China via Singapore, Malaysia, other countries where resellers buy NVIDIA chips and then sell into China. They're not supposed to do that. And part of the new regulation and legislation coming out in the US is to prevent that from happening, is to put trackers into the GPUs, limit which resellers NVIDIA can sell into. So the impact is a direct impact, but there's also an indirect impact on NVIDIA's ability to sell into China.
Morgan Stanley says this inability for the H20 chip to be sold into China is something that analysts haven't yet fully appreciated and says, quote, there is simply no offset to this. Do you agree with that? Or do you see there's another market where NVIDIA can make up the lost?
It's a timeline issue because we do see these bigger agreements made in the Middle East with these Gulf states that are talking about eventually picking up millions of GPUs, but that's not going to happen overnight. And China has already been buying millions of GPUs. So there may be a little bit of a gap between when China demand starts falling off and when the Gulf demand starts picking up. And that's what NVIDIA is going to have to navigate. And they have a rich, diverse customer base, but that is the biggest challenge for the next few quarters.
Well, looking at the timeline, when do you think at least the beginning of that narrative can start to materialize?
It takes a long time. The Gulf states are starting really from a standing start. So they can start planning those big data centers now, but they're at least six months to a year out from having any substantial demand for NVIDIA's chips. So it's at least that long. And to ramp up to millions of chips, that's probably several years.
So there's the issue of China, which definitely will dominate the discussion and the narrative potentially after the earnings. There's also a question of their main customers, which has been the hyperscalers. It was interesting to me that you think that conventional aggregation of some of these hyperscalers isn't going to be as relevant as it has been in the past. Why did you say that?
So the Amazon, Microsoft, Google are the big hyperscale customers for NVIDIA. Microsoft CapEx is already starting to flatten. Amazon is expecting to flatten. That doesn't mean they're not building a lot of new data centers. They are. It's just that they will continue to build them at the same very high rate that they have been at over the last couple of quarters. The places where demand is still growing are companies that are actually using the technology for their own product, namely Meta and Tesla. Meta makes better ads that are more expensive using AI. Tesla makes self-driving using AI. So they're still building bigger and bigger data centers. That demand is still growing. But companies like the hyperscalers, which just turn around and rent out GPU capacity, that's starting to flatten out. So that's why it's going to be harder for NVIDIA to grow from these customers. That's why it needs to continue some demand from China. It's creating its own customers, companies like CoreWeave and other neo clouds where NVIDIA has seeded and invested in so they can build out capacity. NVIDIA is trying to move the pieces around, but its current scale, it may reach 200 billion of revenue. It's very hard to do that and continue to grow at rates that investors are going to want in order to justify a higher multiple.
There also is a question about market share, and it's been the dominant player for a long time. NVIDIA was the growth engine when it came to machine learning and all of the necessary hardware. How much are some of these hyperscalers becoming increasing competitors to them and finding ways to create good enough chips to do what they need to do?
That's exactly right. So NVIDIA is coming from a point right now where they have more than 90% share. And when you have more than 90% share in what is still a competitive market, there's only one way to go from here. So as you're pointing out, Amazon and Google use their own chips to a large extent, and they will increasingly do so. The more AI data centers are there for inference as opposed to training, the more that lends itself to them using their own chips, which they get help from Broadcom in making. So that's one place where there's going to be share erosion. And then back to China, the Chinese chip companies are getting better, and they're getting better fast. And so some of that demand, as NVIDIA is restricted, is going to be supplanted by Huawei. And so from 90% share, there's only one way to go for NVIDIA, and that's also going to be a gradual process over the next few years.
Putting some of these stories together, we've been talking about the One Big Beautiful Bill as well this morning. Do you think all the demand of energy these data centers need means maybe you will have Republicans want to keep some of those green incentives from the IRA and the Biden era? Do you think that the AI story is actually pushing some of them in Washington, D.C. to want to keep some of the grants and the credits we saw?
Well, at some point next year, based on some of these data center builders, customers, it sounds like at some point next year, we're going to hit a capacity on energy. So they really don't care where they get the energy for their data centers. They're less concerned with clean or not clean. They're just concerned with that capacity coming online, and it may not come online as fast as they would like. That's why we even started the conversation about bringing back nuclear and building small modular reactors, because they all see this the ceiling that they're going to hit at some point next year because they don't have enough energy. And the least of their concerns is whether it's clean or not. They just want more energy supply to come online by next year.
NVIDIA needs to buy Exxon or something like that. Gil, got to leave it there. Gil Luria there of D.A. Davidson. Number one thing he's watching later, one word, one country, China. Up next on the programme, Nancy Lazar of Piper Sandler on the continued strength of the US consumer. The opening bell, 60 minutes away. Equity futures on the S&P 500 positive by 0.1%. Yesterday up 2% on the S&P 500. Supercharged by some calming words from the President of the United States over the weekend, backing off on those tariff threats on the EU. The Japanese Ministry of Finance saying all the right things as well, just an indication that maybe they'll back away from long-term debt issuance. And this number, consumer confidence, which we'll talk about in just a moment, a really sharp rebound in consumer sentiment, the biggest monthly gain in some 4 years. I want to turn to the bond market because later we'll be talking about debt issuance. 5-year supply today, 7-year supply tomorrow. Yields this morning, Lisa, just about unchanged on 10s and 30s, lower at the front end of the curve.
It's especially relevant given the fact that we had that 40-year bond issuance in Japan. Everyone expected to do really well given the fact that the Ministry of Finance said, look, we got your back. Well, they didn't. And that's part of the problem that people don't understand. Every auction, particularly as the maturities get longer, becomes a risk event.
And not just the US auctions, but the Japanese much more so, maybe.
I mean, maybe actually we all need to be paying attention to Japanese bond auctions. I'll wake up early.
Lisa wants you to stay up now overnight and watch debt supply coming out of Japan. Yields are unchanged this morning on a 10-year. Lisa's going to do that for you. Special coverage.
You know what? ChatGPT.
Special coverage. 1 hour away from the opening bell. Let's get you some morning movers. Here's Danny Berger. Hey, Danny.
Hey, John. I, for one, can't wait for that. Anyway, on the individual stock level, GameStop supercharging its own shares, up nearly 3% this morning. And March announced that it would start to buy Bitcoin as a Treasury Reserve asset, something that we've seen Michael Saylor's strategy do. Well, we finally got the figure. They announced that they have purchased about 4,700 Bitcoin tokens. That totals about $513 million. So those shares moving higher off that. We also had some retail earnings over the past few hours. Macy's being one of them. Those shares up more than 3.5% after the earnings. They beat on the current quarter, saying that their strategy of shuttering stores and focusing on the really profitable ones, that is working. Now, for what it is worth, they did give a little bit more grim of an outlook, saying that they are concerned when it comes to profitability. That specifically was the thing shrunk down, saying that they will have to take some discounting given the tariff uncertainty and the unknowingness of how the consumer will be doing. Well, here's a company, a retail one, that feels more confident, and that is Abercrombie & Fitch, up a whopping 27.5%. They did something that even the best reports from retailers did that we haven't seen others do. That is raise their sales outlook. Now at the high end, they see a 6% growth, 7% growth rather. Previously, it was 5%. For what it's worth, Abercrombie & Fitch has been making a lot of moves over the past few years to reduce their China exposure. It's about 7% of the merchandise they got. About 2 years ago, it was 12%. So that also helping them in this period of uncertainty, John.
What a turnaround from that company. Danny, thanks for this morning. Appreciate it. Let's stick with the US consumer. Investors looking ahead to jobless claims tomorrow, PCE and UMich sentiment data out on Friday, following a massive jump in the Conference Board consumer confidence yesterday. Nancy Lazar of Piper Sandler joins us now for more. Nancy, it's good to see you.
Good morning.
I want to share this quote from Stephen Stanley of Santander with you. He said the book is far from closed on tariffs, but financial markets seem ready to move past it, and these numbers suggest that households may be moving in that direction as well. Let's just think about this. Do you think there's a chance we could just move on from the volatility of the last few months without any pain or damage?
No, this tariff roller coaster is going to continue. We could have 90-day extensions for the next year as they try to negotiate deals. But it's important to remember there are 3 key drivers for the consumer. One is inflation. And the inflation backdrop may not be as bad as feared with these tariffs, in part because energy prices are down. In addition, second, you've got a ton of supply. Everybody pulled forward into the first quarter. And then third, it's not clear the demand's going to be that strong. And so could retailers end up having too much stuff, preventing them from actually raising prices too aggressively. And then the second major driver for the consumer is jobs. And what the Conference Board data highlighted yesterday, that the Conference Board series, particularly the present situation component, correlates with the unemployment rate. And it rose 5 points, suggesting, as claims are suggesting, that the unemployment backdrop is okay. It's not strong, i.e. the unemployment rate is ticked up. It may tick up a little bit further. But companies don't have to fire people. You ended the first quarter with strong earnings, solid revenues, productivity is strong, profit margins are strong. And so we think the weakness in the labor market is going to come from the public sector, not from the private sector. So net, the job market stays tame. And then third would be the stock market. The stock market has rallied. That's going to protect that high-end consumer. And so net 1% consumer spending. But as you go through the year, I think there could be upside in the back half.
There's a phrase you used I want to pick up on, pull forward. Is there a bill to pay further down the line, and how does it show up in the data?
Well, that's what I worry about. Near term, you could see, and you even saw it in the April data, a little bit of uptick in certain prices associated with the tariffs. As you go through the year, if the consumers aren't buying those higher ticket price items because of tariffs, these retailers could end up having too much stuff, and you could actually see deflation as you move into 2026.
There are 2 ways of looking at this. On one hand, you could say that people are buying all the things that they need now as they won't need them later on, and that could lead to deflation over supply. There's another way of looking at it, too, which is if people are keeping their jobs and feeling really confident and the soft data is going to catch up to where the hard data is, well, people are going to absorb these prices just fine. And actually, you could see a greater inflationary kind of impulse. Which do you think is the bigger risk?
I don't think near-term inflation is the bigger risk. I think that could become in 26, if that after the first half of the year. Near-term, again, consumers did pull forward. We saw that in the retail sales data. Companies pulled forward. We saw that in the durable good orders data yesterday. Inventories are going to continue to increase given the surge we saw in imports. Consumer spending isn't going to be 2 or 3%. It's probably likely to be about 1%, which is on the softer side for the consumer. And it may be unfair to categorize everything in one bucket. It's going to be a bifurcated consumer. That higher income consumer can probably plow through some of these higher price increases. That lower end consumer is still struggling from these high price levels. You have the student loan repayments now also kicking in. You're seeing delinquency rates rise in that space. You're seeing credit scores. So I thought I was going to be able to drop the phrase bifurcated for 2025, and unfortunately not.
All I can say is reading economic data right now is like reading tarot cards, because right now it feels like you could pick out what you want and interpret it in whatever story that you wanted, and maybe it'll sound vaguely truthful for people and they will lean into it.
I thought there was a science to it.
Tarot cards?
I thought tarot cards was like real deal.
Yeah, my son is a physicist, and he tells me economics is not a science. So
there we go. See, it's reading tarot cards. By the way, that's what you lean up on, is that there's a science behind tarot cards.
Just wonder if you're undermining the spiritual essence of reading tarot cards, and people might be offended.
You know, John, please go on about your deep spiritual allegiance.
I could never go into one of those places. I'm surprised how many there are around New York City.
Yeah,
you see them in the windows, like psychics
they
available.
solicit you. They grab your palm. They tell you that you're going to live a long time, and then if you say that you're not going to pay them, they say you're going to live a really short time.
So they do.
Anyway, let's move
All right,
on.
now you brought it up. I was just wondering.
Well, I just think that it's a very choose-your-own-adventure kind of moment. At what point do you know this data is reliable? It's not just this question of distortions.
So it's really important to pick out the data, as you just said, that are reliable. And the University of Michigan Consumer Sentiment Survey has gotten so much headlines. It's weaker than the GFC. It's back to the lows we had in 1979. It's driven by inflation more than it is by the job market. And quite frankly, it's been a very misleading indicator. You have to, what are the key soft data? The Conference Board's present situation, obviously the ISM and the NAHB. Those three tell you housing is indeed weak, which I expect it to stay weak given where mortgage rates are, house prices are. Manufacturing near term is going to be sluggish, but our work suggests you're going to see a pickup actually as you move into the back half of the year into 2026. And then the consumer, as of now, the Conference Board data suggests consumer is okay. The one area I'm excited about is capital spending. In that you have some of the soft data from the regional feds. They have a CapEx outlook component, and it actually turned up in May. We're going to get more data today on that. And so as we go in the back half of the year, I think capital spending from the onshoring theme is going to kick in. So to your question earlier, as far as will there be no pain associated with the tariffs? There'll still be pain. But we have to move towards the tax changes that are unfolding, both the continuation of the TCJA along with the accelerated depreciation or full depreciation for manufacturing equipment and structures, and then also deregulation. So, it's a timeline. Tariffs hit us first. Now we're moving in the summer, and there's going to be more positive things unfolding, certainly about tax legislation. And as we move the back half of the year, we think we're going to start to see concrete evidence of onshoring, and there's nothing more positive for a country than CapEx.
But tariffs will continue. The cutoff date for this latest survey was May 19th, and that was really, I think, consumers starting to digest what was going on with China. But then Trump talked about a 50% tariff on the European Union. So does this Conference Board survey, is it just an outlier because then there was another big tariff hit?
I don't think so. I think the consumers, again, those three things we focus on: inflation, jobs, and the market. Those are net still positive for the consumer. I agree. If you do see a big uptick in inflation associated with tariffs, that could be a little bit of a game changer. But right now, energy is that cushion. And so this tariff roller coaster, again, it's here. We think tariffs settle in at somewhere between 10 to 15% whenever it's over, which I have no idea when it's going to be over. But it's important to look at the broader picture. And again, corporate America is healthy, and it's called a business cycle for a reason. It's companies who hire people and pay wages and build stuff. And so that first quarter earnings season was really important to to see double-digit earning gains, helping explain why the job market isn't deteriorating more aggressively.
Do you think corporate America has already heard enough certainty from Washington? This is, in essence, a negotiating tactic?
Again, I'm out of my league here, but I would say yes, because God knows what's going to come out of Washington next. But at the same time, again, they're in good shape on balance, record high profit margins, strong revenue, strong earnings. They understand now the game that's being played. I suspect they've settled on we are going to end up with tariffs, a permanent tariff of 10 to 15%, something like that. And again, because we're in good shape, they can more effectively deal with it. I worry more about some of the other countries, which is why we probably will get deals. They're not just as robust as the United States is.
There's a real sense we can handle 10%. If you go back to Liberation Day, April 2nd, that afternoon, you remember how it rolled out? People started to think we'd get a 10% baseline. It would just be that, nothing else.
Yeah.
Equities rallied for about 5 minutes and then rolled over aggressively. But when we thought it was just 10%, everybody was OK with that.
And that seems to be the status quo right now. And frankly, that's the message out of the White House. It just is unclear whether you put everything together and you get 10%, because then when you started to look at that chart, people were saying, what? And then
when he held up the board and saw the numbers were a little bit different to what we expected.
And then some White House staffers came around and were delivering these pamphlets to reporters. I looked at this, tweeted it, and then all of a sudden, market's just like tanking.
Nancy, it's good to see you.
Thank you very much.
Constructive view on the US economy as we get deeper into 2025. Nancy Lazar there of Piper Sandler with an update on stories elsewhere this morning. Let's get to your Bloomberg brief. Here's Yahara. Hey, Yahara.
Hi, John. President Trump says he's working on taking Fannie Mae and Freddie Mac public, calling them amazing companies in a post on Truth Social. Trump said the government would retain guarantees and an oversight role over both companies, which have been under government conservatorship since the 2008 financial crisis. Meanwhile, the Trump administration is raising the stakes in its ongoing battle with Harvard and other universities. Secretary of State Marco Rubio ordered U.S. embassies worldwide to stop scheduling interviews for student visas. This comes as the U.S. considers stricter vetting of applicants' social media profiles. And if you can believe it, bidding has already begun for the 2036 Summer Olympics, with one country's proposal drawing attention. Berlin formally presented its bid to host the Games, which would mark the 100th anniversary of the city's last time hosting the event. The 1936 Games are, of course, remembered for being hosted during the rise of the Nazi Party, along with American runner Jesse Owens' defiant winning performance. That's your Bloomberg Brief. John?
Yahara, thank you. Thanks for this morning. Up next on the programme, we'll set you up for the trading day. We'll look ahead to NVIDIA earnings, catch up with Ed Ludlow, who's sitting down with the CEO of NVIDIA later on today, Jensen Huang, at about 6:30 Eastern Time. And we'll speak to Meghan Robson of BNP Paribas on what to look for in this market as we work our way deeper into the week. From New York City, you're watching Bloomberg TV. Live from New York City, welcome to the programme. The opening bell is about 44 minutes away. Your trading diary looks like this at 2 p.m. Eastern Time. We get some Fed minutes after that. After the closing bell, NVIDIA results on Thursday, another round of jobless claims, plus some Fed speak from Barkin, Goolsbee, Kugler, and a whole lot more. On Friday, going into the weekend, PCE, personal income and spending, and UMich, consumer sentiment. For now, though, all eyes on NVIDIA earnings. Due this afternoon, sitting down with the CEO of NVIDIA, the man himself, Ed Ludlow, catching up with Jensen Huang later on this evening at 6:30 Eastern Time. Ed, welcome to the programme, sir. Thanks for coming in on the West Coast a little bit earlier than normal to talk about this. We caught up with an analyst earlier on this morning and said, what's the number one thing you're focused on later? And just in a word, he said China. Is it the same for you?
Yeah, it is, because there's the math side of it, right? They did a $5.5 billion write-down on this special chip for China that they can no longer sell. The write-down relates to inventory and commitments. But I think in recent days, it's been interesting to look at the terminal and see the estimates change and people catch up with themselves and try and work out what portion of NVIDIA's business China is today. That's the kind of job of those watching this program. The bigger picture is that they develop AI in China. And we know that Tencent and Baidu and Alibaba were big buyers of that H20 chip. But Jensen Huang's actually been pretty consistent in his argument that like 50% of the world's researchers looking at AI are either in China or they come from China. And right now it's a market basically closed to him. And so I think the only question is, well, has that door been opened by your recent time with the administration or not?
Ed, what's been interesting over the last several weeks is the relationship seems to have struck with the President of the United States. It feels like the Tim Cook of Apple is now out in the cold. And what we're seeing with Jensen Huang is a very close relationship, particularly playing out in the Middle East over the last month or so. What's your take on that? How is he navigating this moment? How have we seen him fill the void almost where Tim Cook was in the last few years?
Well, it's the people around the president. I know that to be true. You know, David Sachs, Sriram Krishnan, those are the two sort of top AI advisors. It also wasn't always the case, right? You know, I asked Jensen in January when we were in Las Vegas at CES, have you spoken to the president? And the answer at that time was no. He had not spoken to the president or been invited to Mar-a-Lago. I mean, right now, NVIDIA is the world's most important technology company. And, you know, the approach of the administration, I think you'll probably discuss it on this program all the time in the political context, is that it is their prized possession, the administration, to go out around the world, and most recently the Gulf, and say, we can give you access to this. It's almost like, dare I say, a negotiating tool, a bargaining chip saying, we have NVIDIA. What can you give us in return? In much the same way, like, you know, thinking as a student of history, oil used to be like that, right, in certain political discussions. Now it's the AI accelerator, believe it or not.
The man selling chips is the negotiating chip. But, Ed, when it comes to the Gulf, can that fill the void of what they're losing in China?
I think what we don't have from NVIDIA is a very clear dollar value for all of those deals that were announced, right? They are multi-stage over many years. The figure that NVIDIA shared was a Blackwell figure, like X thousand over a number of years. AMD, by comparison, said, for us, this is $10 billion of revenue. And so I think that's a fair question for Jensen Huang. How much money is this worth to you, and by what deadline? But, you know, again, more simply, size and scope. Does this make up for the opportunity or market lost in China? It would be interesting to see how he answers that one for sure.
Ed, looking forward to the questions later on. Ed Ludlow with the CEO of NVIDIA, Jensen Huang, at 6:30 Eastern Time, a Bloomberg technology special. Look out for that a little bit later. The earnings, of course, drop after the closing bell. Lisa mentioned this a little bit earlier this morning. We've had a 44% rally off the low on this stock. Yet on the year to date, positive by almost 1%. This market has totally round-tripped. Meghan Robson of BNP Paribas joins us now to talk about some of that. Meghan, good morning.
Good morning.
A round trip for the likes of NVIDIA, but really for the whole of the market. What's changed? The prices might be the same, but what's changed?
I think the main driver was clearly tariffs, so some of the relief in the 90-day pause. I think that was accelerated by two other factors. So one is positioning. Positioning was very short heading into Liberation Day and throughout the sell-off, and that has started to extend and get more towards neutral. As that process happens, we think the rally will lose steam, and that's where we are now. And I think the second thing we think will change is the data. So for now, we've been in this data vacuum, not much impact from tariffs yet, but we think that will change. And as that happens, credit spreads are not pricing that in, and we think could drift wider.
There are three different prongs, particularly when it comes to fixed income. On one hand, you have this question about the fiscal overhang and just how much debt all developed markets are going to be issuing. You have a question about the economic data. That's what you're talking about with respect to this idea of us seeing the impacts of some of these tariffs. And then you have this question of whether we've just structurally changed and whether international investors aren't buying U.S. debt in the same kind of capacity. Which is the sort of sticking narrative for you that you think actually is a game changer?
I think the foreign investors is very topical right now. So foreign investors own over a quarter of the U.S. corporate bond market. So far, we have not seen selling or evidence of selling. So we follow things like overnight trading data during hours of Asia. That still suggests there's net buying. But to your point, there's two factors. The dollar is weaker. So if you're a foreign investor holding a U.S. asset, you're worse off. And then in certain places, across the globe, local yields are higher, so there's other opportunities to invest. So I think it's something we're watching. So far, haven't seen selling from foreign investors quite yet.
But it goes to the question that John was asking, which is how much has changed, right? We've been on this sort of incredible volatility, and yet we aren't that far off from where we were to start the year. How much do you lean into this idea that we are at a structurally higher yield moment, driven by the fact that there are these competitive advantages with the yield market of, say, Japan for the United States, versus going back to something more familiar where economic data will drive people back to the bond market?
So I think higher yields have been a benefit so far structurally. So yields higher, Treasury yields higher, credit spreads tighter. That's how things have worked so far. But we're getting close to that inflection point where higher yields can start to challenge credit. So when you have a break-even yield level of around 2.3%, where we are today, if we rise above that, that's where investors start to worry of inflation. The Fed potentially can no longer cut rates or has to be more hawkish than expected. So I think for now, higher yields has been positive, but we're at that point where it could be more of a headwind.
Meghan, you said that the data so far has not reflected what's going on with tariff policy, and you're going to have this post-tariff reality in the data. What does that look like?
We are most concerned about an inflationary impulse in the data. So growth can slow, but I think the bigger risk for credit would be inflation. Our economists do think and are out of consensus in that there will be some staying power from tariffs on inflation. We have 0 cuts in our baseline forecast for 2025, and the market's not pricing that in yet. I think along with that, we could see the growth data slow. And from our work, that usually happens with a 1 to 2 quarter lag from when sentiment bottoms. So if we saw sentiment really weaker at the end of first quarter, we would expect to see that in next quarter earnings or in third quarter, and things like lower CapEx, EBITDA growth, inflecting negative potential.
Can we quickly finish on the most Bloomberg question ever? The boom in reverse Yankee bonds.
Yes.
What gives? What's that about?
So issuers can take advantage of lower yields in Europe. So a huge theme in credit has been we've seen a surge in issuance of U.S. issuers going into Europe and borrowing there. You can save about 200 basis points in terms of borrowing costs. So it's been a theme, less supply in U.S. So it's another factor that has supported this rally where the technicals are just more positive for our market.
Interesting. Fun to fit that in. Thank you, Meghan. Meghan Robson there of BNP Paribas. You've been following the same thing.
Oh, yeah, it's a record.
Of course, there you go. It's a big deal.
Everyone's going to Europe, not just to have vacation, but to raise money in the bond market, because also they're hitting their peaks in the indexes in the U.S. So if they want new investors, they go over to Europe, and it's getting to be a deeper market. They're very excited. I think it's a great question.
There you go. For anyone interested in the terminology, Yankee bonds, of course, companies outside of the U.S. issuing debt here in the United States, so reverse Yankee.
Maybe it's just people who want an excuse to travel to some of these regions where food is quite good.
Possibly. So I hear, going into the summer.
Maybe.
OK. Coming up tomorrow, Bob Michael of JP Morgan, Libby Cantrell of PIMCO, Michael Zezas of Morgan Stanley, Anastasia Amoroso of iCapital, breaking down some important numbers later on this afternoon. NVIDIA reporting after the closing bell. Ed Ludlow catching up with Jensen Huang, the CEO, at 6:30 Eastern Time. Do not miss that. From New York City this morning, good morning. Thank you for choosing Bloomberg TV. This was Bloomberg Surveillance.